All right, we're ready for you to call the roll.
Governor Lujan Grisham. Commissioner Garcia Richard.
I am here.
Treasurer Eichenberg.
Present.
Secretary Romero. Mr. Jennings. Mr. Lavender.
I'm here.
Mr. Rawson.
Present.
Mr. Messina.
Here.
Mr. Tejas. Miss Allen.
Yes, here.
Mr. Bingaman.
Present.
And Secretary Romero.
Present.
Madam Chair, we have a quorum.
Wonderful. Thank you so much. And welcome to everyone. For those of you joining us on Zoom, we've got 3 members here in person, and we've got RVK is in the house with us. It's great to be here, live and in color. So with that, I think we're going to move to approval of our agenda. Do I have a motion to approve our agenda for today's meeting?
So
Gerald,
moved.
so second.
We've got a motion from member Lavender, second from member Allen. Any discussion on a motion to approve today's agenda? Hearing none, we're going to have Andy take a roll call vote.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0. Oh, Ms. Secretary Romero.
Yes.
My apologies. The motion carries 8-0.
Very good. Thank you, Andy. Next, we're going to turn to the minutes from our September meeting. Any discussion on those? Make a motion?
So moved.
Okay, I'm sorry, member Allen, because Harold is right in front of me. He gets the motion, you get the second. All right, so we've got a proper motion by member Lavender, a second by member Allen. Any discussion on a motion to approve September meeting minutes? Hearing no discussion, we will go to a roll call vote to approve the minutes from September's meeting.
Commissioner Garcia Richard.
Yes.
Treasurer Eichenberg.
Yes.
Secretary Romero.
Yes.
Mr. Lavender.
Yes.
Mr. Roston.
Yes.
Mr. Messina.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Very good. So then I will turn it over to our State Investment Officer, Mr. Moise, for agenda item 2A, our briefing.
Thank you, Commissioner. Good morning, everyone. I would ask you to take a look at my briefing for October, and we'll start with item A2, distributions and contributions. Total distributions for the last 12 months as of September, $1,186 million rounded up. September 22 inflows from the state land audits. This is impressive. $251,692,847, an all-time record. Pardon me, $263,712,420 for September. That is the record. And from what we can tell, Commissioner, that may continue for a while. That is a 3-month lagged number, as all of you know. And I'd like to comment briefly, as we're on this topic, about a report that you are going to be seeing next month from our staff. Our staff has developed a model to project future inflows into the Land Grant Permanent Fund through the year 2050. The output of this analysis will primarily be used for the intergenerational equity study that we perform annually for the land grant fund, and also for our internal pacing models. Royalty contributions to the fund are expected to grow from the 1.3 billion received in 21 to this new record high of $2.6 billion by the end of this year, this calendar year. And as all of you know, much of that growth is due to the higher price environment of 22, as well as continued growth in the oil and gas production on our state trust lands. Current forecasts suggest oil prices could remain elevated for the foreseeable future. For example, West Texas Intermediate averaged about $53 a barrel from 2015 through 2021. But economists now estimate oil prices over the next 10 years to average about $70 per barrel. Additionally, oil and gas production in our state is expected to reach new highs every year through the early 2030s, before potentially declining in the years after that. So what does this mean for inflows? Based on current forecasts, we expect royalty contributions from the state trust lands to remain above $2 billion each year through the early 2030s. Staff will continue to monitor the oil and gas markets moving forward and periodically adjust the inflow forecast as new data is received. And we look forward to sharing the details of the analysis with you in more depth next month. Dawn Iglesias has done a lot of excellent work on this topic, and she is planning to address inflows to the severance tax permanent funds as soon as time permits.
Steve, if I may just add two more data points to that analysis. So one is that we have had greater interest than ever in our monthly lease sales. So we had the largest number of bidders 2 months ago in our July lease sale, well, now 3 months ago. We had 32 bidders, registered bidders. Last month, and so just a few weeks ago, we had an 80-acre tract go for $2 million. So this sort of competitive nature of the limited land we have left, I think sort of indicates, that ever increasing interest in drilling on state land.
It's almost complete. And as we look ahead, it's encouraging for the land grant funds, encouraging for the distributions to the state. Thank you, Commissioner. Net asset value of our funds as of Friday was $36,751,000,000. West Texas Intermediate was $85.05 as of Friday. It was $82.50 a year ago. The New Mexico price, $81.67 as of Friday, and it was $81 a year ago. U.S. rig count, 981 as of Friday, up from 706 a year ago, and the New Mexico rig count up from 87 to 105 as of last Friday. It's hard for us to get the New Mexico natural gas numbers currently, so all we give you is the U.S. As of Friday, $4.96 per 1,000 cubic feet, and a year ago, $5.12. Looking a little deeper into the briefing, let's go down to item D, operations. We're still sourcing both a real return and a fixed income analyst, those two positions. We're getting closer on at least one of them. Let's see what else might be of interest to you. The assets under management for the permanent funds have grown substantially in the past 12 years. So from 2010 to 2022, we have seen a $22.8 billion increase over the 12 years in our total assets under management. I tell you that so that we can view it in the context of our staff numbers. In 2010, we had allowable staff of 31. This year, we have allowable staff of 26. So with a $22.8 billion increase in assets, we've had a decrease of 5 staff members over those 12 years. These are the numbers that we are permitted to have by the powers that be. Brent presented in our budget presentation just recently the request for an additional 5 staff members, and we're hoping that we will be permitted to have those additional staff. It's a little bit unbelievable to me that our staffing is controlled as tightly as it is with the amount that we are producing for the state, but that is the way it works. I'd like to ask Charlie to comment, if he would, on client matters and any legislative matters.
Sure. Thank you, Steve. Commissioner. So the city of Rio Rancho is the latest client to be added to our mix. I think we're up to 27 now. We have a JPA, Joint Powers Agreement, that should be approved by DFA Legal Review in the coming days, and we're expecting them to invest about $10 million with their new endowment. Their voters approved this, and they chose SIC to manage this money for them, and we're very excited not only to get that, but with the concept. Other clients, we are seeing a couple of the larger clients that we have, and they are migrating funds away from traditional assets into the private market pools to a small degree, but it's growing interest in those assets, including real estate, private equity, real return, and credit and structure. To do that, to qualify to move into those pools, those clients have to have a minimum of $10 million in investment assets, as well as an external fiduciary advisor. Steve mentioned the LFC hearing we had last week where Brent presented our budget request. We think that went very well. It was a good discussion between the committee. Committee also asked to hear from the CIOs, Vince, as well as the CIOs from ERB and PARA regarding market outlooks and challenges. That was also a beneficial conversation. Recruitment and retention seems to be a consistent shared concern among the 3 agencies. But I think we may have made some progress in there, and at least getting that issue in front of the LFC. Brent will probably go over the budget request. We had a small top line increase of 2.3% year over year. And the expansion of those 5 FTE positions that we've requested in our budget, that would get us back up to 31. We're optimistic that that could happen this next year for FY24's budget. Madam Chair, that's all I have.
Whatever we can do to help advocate for that.
Thank you, Madam Chair. I might add to what Charlie said. We also had a discussion with LFC about compensation and the fact that New Mexico is not competitive with peer states.
Excuse me.
Issue, and we need the support of the council, the legislature, and the governor to help us attract and keep good people. We can't do it unless we pay them competitively. It's public sector compensation, not private sector. Thank you. That's my report.
I do have one comment that this is probably shooting at a sacred cow. I guess that's not supposed to happen, but I'm still baffled that the University of New Mexico and New Mexico State's endowments haven't chosen to avail themselves of us. And I know there's not anything I can do about it except make a comment about it. And I just think it's pretty crazy when you compare how they've done over the last 15 years to how we've done over the last 12 years. I'll put it in that context. It's mind boggling. And I guess there's not anything we can do about it. We can't force it, but it sure is short-sightedness on the part of the two institutions not to avail themselves of what we have here. So anyway, that's just a comment, but rankles me every time I get the reports.
Madam Chair, I guess a couple of questions. You mentioned that we have 27 entities that we're managing their funds for. What's the total amount of that we're managing? And then I guess along with that, I mean, we talk about the total amount that you're managing. I'm sure that that's part of it. And so are we charging anything for managing? I mean, do we have an administrative fee? Is there something that helps us? Because I mean, you could do something about that now in hiring people if we were doing something like that.
So, right. Madam Chair, Secretary. So the last I looked, we're about 1.6 billion that we manage for those entities, the largest being Retiree Health. They've got over $1 billion with us, so a lot of smaller clients after that. We do not charge administrative fees and costs. We kind of view this as part of our mission, and that we would be managing the permanent funds anyway. So these additional funds go into the unitized system that we use, and it's some additional administrative overhead for sure. Brent can speak to that better than I can. His people work very hard, and it is complicated what we do, but it's a no-frills service. We're not telling them how to invest. We're just giving them a menu of 14 different pools, and essentially we're trusting that they are making good investments in our pools and benefiting from our low costs and just efficiencies. We have lower fees. That is all they pay. They pay the pass-through fees that basically are paid for participating in the pool, but no additional overhead. That we don't charge that.
And Secretary, we ask that each of them have professional advisors to help them decide how and where they should invest.
Thank you, Madam Chair.
Thank you. Anyone from the Zoom screen? Or either Charlie or Steve?
Madam Chair, this is Tim.
Mr. Treasurer.
Thank you. Stephen, in our local government investment pool, we also have well over $1 billion, and we charge. We get 5 basis points as an administrative fee. Now, the legislature, in their infinite wisdom, has used some of those monies against our budget. But it amounts to hundreds of thousands of dollars when you look at it over the course of a year. And that could be used to help increase some of the salaries. Just a thought that you might look into as you go forward. Thank you, Madam Chair.
Thank you, Mr. Treasurer. Anyone else? All right, hearing none, we are going to move to agenda item 2B, our Chief Investment Officer briefing. Mr. Smith.
Thank you, Madam Chair. Well, let me start on the macro side. There's just a ton going on. There has been, geez, for a couple of years now. I know it's all set up here. Yeah, but let me start with a comment that we made in the annual investment plan. One of a handful of concerns that we had going forward, and it was about the impact of rising interest rates, mainly here in the short run to fight inflation. So we know the Fed's been running interest rates up, basically from 0 to over 3%. We've got the rest of the big central banks around the world doing the same, increasing their interest rates. One thing that concerned us as these central banks fight the inflation that's in place now, that's a little bit different than when they were fighting inflation in the 1970s, is that the world is just swimming in debt. much more so than it was back in the 70s and early 1980s when Paul Volcker was jacking rates and trying to get his hands on inflation. That the concern there, of course, was the risk of the beginning of debt defaults, and at worst, a cascade of debt defaults. So one sector starts to default, and then it impacts the others. That's a very low probability event, but we wrote about it in the annual investment plan. Almost immediately, the UK steps forward with an example of what we were talking about. So it's big enough news. I'm sure you all read in the papers what has been happening over there. So we won't belabor that any. But at the root of it, the UK government talked about tax cuts to try to spur some more growth in the UK, without also talking about offsetting expenditures by the government. Now that's not a bad economic thought, because at the end of the day, if you get the growth, you get higher tax receipts, and it winds up paying for the amount of deficit spend you had to do. However, investors decided that the UK's credit card was already full. It didn't have any room to further deficit spend, and caused a big sell-off in the gilts market. And the gilts market is their treasury market. That had knock-on effects across the economy. So of course that's higher interest rates. Of course, when the bond market sells off, longer-term interest rates go up. That had higher interest rates for anybody that had floating rate, British pound debt, higher interest rates on people making new purchases and things that require debt. So big ticket items. All that stuff's expected. It also had an impact on the pension funds. Many of the pension funds, or most of the pension funds there, are actually use liability-driven investing, which basically means holding a portfolio of bonds that has the cash flows and the maturities that offsets your liabilities as they come. That's a popular strategy here in the United States with corporations, not as much in the public space. We're all sort of growth oriented here. But the UK does it in a particularly aggressive manner, where they take their bond exposure in the futures markets, and they use the cash that they don't have to use to buy physical bonds, and they invest it in illiquid things like real estate and private equity and growth assets. So as interest rates rose, they started getting margin calls on their debt that they couldn't pay because they had their money invested in long-term illiquid assets. Now the central bank stepped in and stemmed the tide, offered credit to any of the funds that needed it. Several, I think, did take advantage of it. But I make that point of what's happening there as to highlight that particular risk that we raised in the annual investment plan. As rates go up poorly, if you're in an aggressive financial position, it's almost always bad for you. So the UK was an aggressive budget position. Those UK pension funds were in an aggressive investment position. That's what can happen. That's what we were addressing in the annual investment plan. That kind of stuff can cascade. It can spill out into other sectors of the economy, and of course outside of that country. Very well could. Many other countries have and individuals have debt issued in Great British pounds that'll be tough for them to roll over if rates stay this high in Great Britain. So there's always a connectivity in the financial markets. And what we have seen so far, and still sort of playing out in the UK, that's the kind of stuff that we were discussing in the annual investment plan. We're trying to keep our eye on. So that's the most current happening in the macro or global macro markets anyway. Speaking of the annual investment plan, I wanted to let you know that we're going to bring you 6 additional briefings that we haven't in the past. The macro team from I think beginning next month. We may be able to do it next month. If not, we'll start in January through the spring. So we've had a big enough turn in the global economy, in the global financial markets. And we tried to write as much as we could about it in the annual investment plan, gave you a sort of a history lesson as a basis, and here's how things are different than they have been. So we're gonna cover more in depth the three things that we normally cover in the annual investment plan: growth, inflation, and rates. But we're also going to cover a little bit on the valuation of the stock markets, which is still very high despite the sell-off that we've had, and we talked quite a bit about in the annual investment plan. We're going to talk a little bit more about demographics, which played a pretty big role in the annual investment plan this year. And then we're going to do kind of an interesting study. We've got 10-year forward-looking forecasts from a forecaster that we follow that go back more than 15 years. So we know what they were forecasting for 10 years forward 15 years ago. And we're going to look for times in the economy when rates were higher, which is one of the expectations going forward here in our next 7 to 10 years. And multiples in the stock market were quite a bit lower. And we're also expecting that for the next 7 to 10 years. And see what they were forecasting at those times and give you an idea of what forward-looking forecasts could look like if we get the environment that we expect over the next 7 to 10 years. That'll be positive news. It won't be a 7% anymore. They'll definitely be up, but we want to try to give you an idea of what that'll look like. So I think you'll find all 6 of these interesting. We're going to break them up among the strategy group, myself, Kyle, and Don, and present those to you over the spring. 2 other things I wanted to touch on first. Several years ago, as we were diversifying the portfolio, and we really made a big diversification move in 2017, and had diversified some before then because of the extreme equity position we've been in. There were lots of newspaper stories about a 70-30 portfolio, and why are these big funds so diversified and paying higher fees than they would if they just simply had an indexed portfolio of S&P 500 stocks and for 70% of their assets and 30% of their assets in a nice safe treasury portfolio. How silly is that for them to spend the fees to be diversified? The 70-30 portfolio has been hit harder than just about any time in the past. And it's mainly a function of the bond market has had its worst year since something like 1928. We've never had a bond market this bad in my investing lifetime. Just by rates, longer rates going up as well as short rates. So we have double-digit losses in the core bond portfolio, in addition to double-digit losses in the equity markets. So I point this out because there was a lot of smoke and fire about one specific investment strategy that happened to be working over that particular period of time. And we just can't do that. We can't flip from a 70-30 portfolio like they were lauding to something more diversified that's performed as well as ours has on a relative basis just by snapping our fingers. It takes us a long time to move into the private markets. It takes Chris a heck of a lot of work to get private equity managers in and funded. And we started that process 5 years ago, and we're finally where we are now. The performance report that you saw in June, the one you'll see today, the one you'll see in September when we have some peer results, we lost about 2% for the year through June, but there were funds out there that lost 13 and 14%. So it was a lot more comfortable for me to come into the room and say, markets have been tough, we lost 2%, than it was for my peer in this other large fund I know of, who had to walk into his boardroom and say, markets have been tough, we lost 13%. Now, I know that they understood the risks that they 2021. But our current diversified portfolio, I think, stands up pretty well over the long run, given the sort of markets we're in. Then that more simplistic portfolio. But I wanted to raise that issue a little bit for you. Last, just on some operational things, Steve covered our hiring process. We're still looking for 4 all total. So we actually may have an offer out here for a fixed income analyst this week. I'm expecting we will. We'll see if that can get pushed through, or if we can push that through. We're re-upping our real return analyst ad that posting that expired on us, so we're getting that going again. We still need to we'll need to get an analyst to replace Chris as he moves into Dave's spot. And then one more investment strategist on my side. That'll fill us up to 12. And for probably the first time since I'd say 2013, we'll be, if we attract those 4 people, we'll be full. So good news, at least from my perspective, in terms of having folks in seats and doing work. We're still struggling. I think Steve mentioned this too. We're still struggling, and it's primarily on a salary basis. We're just getting people hired away from us. That causes more problems than a single vacancy. One of the reasons that we lost the positions that we did, Steve mentioned we were at 31 and we went to 26. One of the reasons we lost the positions we did is we'll get 2 vacancies. There's a hierarchy for me in terms of hiring folks. So I've got to have asset class directors in the seat. That's the most critical seat I can have. Marcia Matias tell you on a regular basis that it's our strategy and our asset allocation that primarily make our returns. Problem is I can have the best strategy and asset allocation in the entire world, but if I don't have Chris here to execute it, we can't get it done. So I've got to have the asset class directors in the seat. And then from there, I'm sort of conflicted. I've got strategists that help me get that good asset allocation in place against analysts that help the asset class directors get the best investments. And that's tough because the strategists go a long way into pushing our returns all total. But at the same time, if we can't execute it, it just doesn't matter. So what's happened to us, or what did happen to us that got us partially to get our positions taken away, was we'd get a couple of vacancies. I'd have a priority, we'd fill one. And then before I could fill the second, I'd get another priority vacancy. And so that spot stays open. And so it looks like that spot's been open for 5 years, but it just hasn't because of the way people have come in and people have left. And the priorities that are involved in trying to get seats filled. So that was our main problem. I'm hoping we can get these folks to come in, that we, at least the one we've got the line on, and I'm actually optimistic on the others. They're good jobs. We're starting to see some higher or some help or at least some interest in terms of getting our salaries up. So I'm a little bit optimistic about getting these filled, but we'll see if that happens.
Remember Romero.
So help me understand how you're having that conflict. I mean, what is your process consist of that you can't hire or you don't advertise all of these positions at the same time? What's causing, you to have to pick one over the other?
So we'll advertise at the same time. Mostly, sometimes we'll hold one out if we just haven't had any candidate pools. Because if we have 2 jobs out, the crossover applications are about 70% on average. So we'll have people apply for both jobs. 70% of candidates will apply for both jobs. Often we'll just get one in, and we tend to get a reasonable number of people apply, just not of the right experience. That's our biggest holdback, is we just can't attract them more. And we're not looking for a lot. It's just to have some idea that the person we're bringing in, has seen some things and done some things that can be of help to us. And we've got a pretty good track record of pulling in people that, have some experience. We're very willing to wait to get the right person. So what'll happen is we'll get those 2 positions, but we'll only find one person that's really qualified. We'll put them in what seems to be the greatest need, and then we'll get a vacancy somewhere else, and that second position is still open. So that's the reason I think it's one of the reasons we've had the positions pulled from us, start at least the investment positions. And I think Brent to some of the same problems on the accounting side.
Thank you.
Lavender.
Is there anything that those of us who aren't directly involved in the political process can do to try to help change this steel wall we're butting up against relative to employees? It's ludicrous to me that the people who were hired by the SIC to manage these funds, which are reasonably substantial, I've made the comment before that $36 billion is a lot of money for a kid from Raton. And I think that when you look at the process, it's ludicrous to me that with the money that we make, that we have this overlay of the state requirement that just doesn't make the slightest bit of sense to me, whether it's ego, whatever it is that's keeping this the way it is. Is there anything those of us who are just members of the public can help to try to do about this? I mean, I'm asking that sincerely. I don't mean that in any way other than the fact that it doesn't make any sense. We ought to be able to pay what it takes to hire the full staff to manage these funds. Just that simple in my
Have
mind.
flexibility around vacancies, filling positions that are of greatest need at the time and not being sort of penalized for keeping things open. So I just think increased flexibility is the answer.
One other thing that possibly could be done, Member Lavender, is so Steve mentioned that the 3 CIOs had briefed the LFC here a week ago or so. One thing we didn't say to them, that it didn't occur, I guess, while we were sitting there, but our main problem is comp. And so the LFC, as well as others, get a report once a quarter that compares our performance relative to our peers. And our peers are hiring our people away. That's one of the reasons we lose folks. So we lost Paul to Washington, lost Clay over to Florida, and we've lost 2 others to other state agencies. Those hurt the worst, right? When retirements happen, that hurts because it's a senior person, but we're glad they get to retire. Private sector will hire our folks away. We understand that because they have greater resources, and that's fine. We understand it. Makes us mad, but we understand it. When we lose them to other public funds, that stinks. That really hurts when that happens. So they get a report every quarter done by their staff that compares our performance to our peers. And while no one's ever expressed it to me, I can imagine there's a general desire to have that performance be in the top half of our peers, but they pay us all in the bottom quartile against our peers. Getting that sort of message out, I think, just that basic understanding of what's happening, I think that's helpful.
I think Mr. Moise wants to add something and maybe.
Thanks, Madam Chair. At our budget hearing, LFC Chair Lundstrom, I think, described our dilemma better than I've ever heard it described. Those of you who have read our mission, vision, values statement see that we refer to ourselves as a institutional investment management firm, not an agency, not a department. We are a business. We are an investment business. And what Chair Lundstrom said was, you are a private sector investment management firm in a public sector governmental setting. That really doesn't work. She was correct. Other states have extracted their investment management arm, their sovereign wealth funds, and some of them, perhaps the pension funds. I'm not so sure about that, but I am sure about sovereign wealth funds from the governmental bureaucratic world. I'm not advocating for that today. I'm just saying that is the issue.
Anyone else want to weigh in on the Zoom screen?
Madam Chair, this is Tim.
Yes.
I would just kind of go along with a lot of the things that have been said, but the frustration that I've had as treasurer over almost now 8 years is the basic foundation of our investment people. Because when I came in, it had just been passed through the state personnel office that no investment individual had to have an undergraduate degree in just 4 particular areas. And I think they were math and finance, accounting, and economics or something. And so my first year, as I tried to promote Vicki Hangis into the chief investment officer, she didn't qualify because I think her undergraduate degree, well, I know her undergraduate degree was not in any of those 4 particular areas. Yet she had 20 experience on Wall Street and then had been in the treasurer's office for 4 years. So I think it gets down to the fundamentals. We've kept one of our positions vacant for, it's been vacant now for over 4 years. We just got to fill it just recently with somebody that was willing to work for the amount of money that we could pay them. And we were very fortunate to get them. It's sad because I think Steve hits it right on the head. Look at the money that we bring in, because the treasurer's office has brought in almost $500 million in the 8 years I've been there. Yet none of the 3 people that I have working for me now in the investment field make more than $150,000 a year. I think Vicky's the highest paid and she's like 140. So it's kind of sad. You know, you can't bring them in because you can't pay them what they're worth. And if you went out to private enterprise, and no different than what Steve has pointed out, or Vince, that if they went to private, they would be making 3 times what we're paying them now. So, and retirement's nice, but to me, it's not worth that much. We're fortunate to have Vicky because she had finished a career back east and came to New Mexico to live. Anyway, just one more thing to throw into that equation. The 4 underlying requirement for the undergraduate, I think, is also kind of a false leader. Somebody can have a biology degree, go into this field and work their way to the top. And that's somebody we want doing our investment program. Thank you, Madam Chair.
Madam Chair, just one final comment to leave it on a higher note.
After your note.
Yeah, I should have reordered my stuff here. As you know, we track our capital calls every month, and of course, fund what was called for and receive what's not, or what's turned back to us. We've continued to have pretty steady calls into our private portfolio. So on Chris's side, on the private equity side, we're averaging about 40 million a month or so on calls. So we're able to get money in the markets here at these lower prices. We're assuming and hoping that, and in some cases know, that our private equity managers and other our private market managers are paying lower prices for the investments that they're getting us into. So still good steady call from the private side. It's not pushing money as hard as it was there last year, maybe 18 months ago, when we were sort of maxed out on our equity investments and sort of wondering what to do with the additional cash. That picture has really changed and is better today.
We'd love to hear it. Thank you very much. So anything more on this item before we move to our monthly report? Okay, I'll turn it over to yes.
Thank you, Madam Chair. Thanks for the comments. Good morning, everyone. We do have the August flash report in the packet today. We'll be pretty brief because it is a mid-quarter report. We'll have the full reporting, quarter-end reporting at the next meeting, along with the summary that provides more of the relative results, which have continued to trend quite nicely for a lot of the reasons that Liz had mentioned, a lot of the downside protection in this type of environment. So we'll just talk a little bit in terms of market performance. I won't cover any of the macro aspects. I think Vince did a great job on that. So nothing to add to that end. But as you look at page 18 at the bottom right-hand side, you can see the market performance and the month to date and the quarter to date, a little bit of a different experience, primarily due to quarter to date, including July, which was positive, although that positive performance was relatively short-lived. So you can see August reversed that quite quickly as it became clear that central banks were doubling down on their policies of tightening essentially monetary policy going forward in an effort to regain control of sort of runaway inflation that was experienced. There was a bit of a hope that some of these initial rate hikes taken hold, and that clearly hasn't been the case to date. As you look at the the top right-hand graphic, that's the yield curve at different points in time. One thing you'll see, even just month over month, or as you compare to some of the periods further back, that the yield curves has shifted up and has flattened out quite a bit over that time period. At the time of August, the 10-year had crossed that 3% threshold, but it's continued to rise, and through this week, it's north of 4%. So it's been substantial moves from a very low point, and that's had meaningful implications, particularly in the bond markets and in any other duration sensitive assets, so assets that move in line with rate movements. On the performance side of things, as we said, a little bit of a mixed start here. When we look into September saw that sell-off continue, and was pretty meaningful through that period, and another rough quarter that we'll report on next month. Vince mentioned that 70-30 portfolio that's done so well for essentially the past decade plus, where liquidity and essentially rates were at record lows. That came to a very abrupt end. Just for context, that 70-30 portfolio calendar year to date, so for those first 8 months of the year, would have sold off 17% compared to 7% in the land grant. So that's a 10% more meaningful downside protection, and substantial. Now, never want to see negative numbers, but it just goes to show that that 70-30 portfolio is not a silver bullet either. Non-core fixed income, as we get into some of the portfolio results, and as I said, anything with less duration risk or interest rate sensitivity has done better, and all the diversification that's built into the portfolio is certainly paying off now. Real estate will return, won't just be additive on a relative basis, but may provide some absolute positive contributions to total performance. So that's constructive as well. Just maybe in terms of October, just because we're seeing a lot of volatility to the degree that that's of interest, a bit more favorable for equities, although volatility is very high. Equities are up though for the month, broadly speaking, and fixed income has sustained some additional losses, so that it'd be interesting to see the losses year to date for equities and fixed income in some cases are actually converging. And so we'll have to continue to monitor that. Happy to take any questions or comments, and otherwise pass it on to Marcia for remarks on each one.
Chair, thank you, Matthias. I'm going to take you to page 20 of your diligent and just talk briefly about performance. Again, this is inter-quarter, so I'm going to spend a lot of time on it. We will, as Matthias said, have executive summary for you next month, which will be through the third quarter. You are diversified. You built this portfolio to perform better in down markets, and that has been the case. You can see the numbers here on page 20, just putting into perspective what Matthias said, that the land grant on a calendar year to date basis was down 6.88. And as the 70-30 portfolio that both Vince and Matthias mentioned was down around 17%. So that when you look at your peer performance, we saw that last quarter, you did well against your peers because you had built diversification in over many years. Those who might want to put diversification in their portfolio now, you can't do that overnight, as you well know. You've been building out the diversification for years, and it's serving you well right now. For the month of August, you can see the numbers. The land grant was down 1.86, but at that point, at the end of August, you were still positive for the quarter, which is your fiscal year to date. That won't be the case next month at all. So as Matthias said, you're trending well. You're trending well because of your diversification, but you're going to see worse numbers when we bring this to you next month. You'll see quarter performance, but your allocation, you're in pretty much in your target ranges with allocation. as Vince said, getting money into the private markets, you're still doing that. The market also brought you into balance more because of the loss in equities and core fixed income. But so you can, if you would like, look at those allocations on the following page. I did just briefly want to take you to page 26. And as Vince mentioned, you know, we believe asset allocation drives the return. But you have to be able to implement it. And here we're showing you each of the asset classes. So that with the total fund down for the month 1.71, looking down at US equity, as you know, down over 3.5%. So in the month of August, both US and non-US equity lost about the same amount of money, over 3.5% for each. US equities were positive on the quarter because of the strong month of July. Don't expect that. When you see the September numbers, just also want to point out on your core fixed income. And by the way, we had a really nice visit with Tom and Mikhail, who came to our office last week, and we met. We worked with the asset class director for fixed income on the public side, and you just hired Makita to work on the non-core fixed income side, and we had a nice meeting with the two of them. And then we also met as a group with Makita, which was great. So we had a half day session and a full day session, and I think it was very productive. So looking at your core fixed income composite, as Vince and Matthias both said, fixed income markets have been very difficult. For the month of August, your core fixed income was down 2%. The ag was down 2.83%. And your non-core was down, but it was only down 0.22. So that diversification with less interest rate sensitivity, duration risk, and the non-core portfolio has served you well. You can see positive returns on your non-core fixed income composite, except for the month, which is different than you can see for your non-core portfolio or your core portfolio, which is down almost 10% as of August for the calendar year. And if you go to the next page, you'll see a lot of zeros. That's why we're not spending a lot of time on this, because we don't have the marks for your private portfolios, and they make a substantial part of your portfolio, and that added that diversification that has helped you. So with that, Madam Chair, we're happy to take any questions, and it's nice to look you in the face and say that.
That's amazing. Questions on the August report? All right, we've got a long voting agenda, so let's move on. I'm going to ask the chair of our investment committee if he'd like to make any comments on agenda item 3A. Member Lavender.
Thank you, Madam Chair. I just quickie, and that is that you obviously have the advantage of hearing Vince and Matthias and Marcia talk about what we hear at the beginning of the investment committee. So I think the important thing is to move on to the various investments. There was not a see if I can spit it out, a unanimity of agreement on each of the investments. And I know that Lee has some opinions he'd like to share, but I think that it's important that we look at each one of these as we always do. And each of these was recommended for approval by a majority of the committee, but not unanimously. So I'll cover each of those as we go along. Other than that, I think it's important to move on to whatever it is, 3A or 3B.
Let's do it. All right. So our very first vote of the meeting, we're going to go to Cure Ventures Fund 1. I will turn it over to Mr. Cassidy, who is also here in front of me.
Good morning. Good morning, everyone. I'm going to start with some high-level comments on how we look to build the underlying asset class portfolios. So we are trying to build, Vince allocates a certain percentage of the portfolio to us, gives us a benchmark. That benchmark for us is a private equity portfolio, includes buyouts, growth equity, and venture capital. So you're kind of seeing three good examples here of different segments of that allocation. We're looking for the best in the world in all segments of how that portfolio breaks down. And we're looking for firms that, generally speaking, can show that they're creating value for companies. They're through operational improvements. In the case of Cure, they're actually creating companies out of research and
universities, good track records of doing so, and frankly, asymmetry. I think it's something kind of that's forgotten in our asset class, that if you do these things well and you buy right, you can produce excellent returns. And, you know, for each strategy, we have a definition of what we think that means. But in all cases, each of these three examples have proven that over time in their teams. So let's start with Cure Ventures 1. I'm joined by Richard Pugmire from Mercer, as well as Richard Lim, Lou Tartaglia, and David Falacci from Cure Ventures, who are our managing partners. We're recommending a commitment of up to $35 million to Cure Ventures 1. This is a team that's come together with multi-decades of experience in biotechnology investing, particularly in actually creating companies. What do I mean by that? They're going to research labs or universities, taking foundational intellectual property from those universities, working with the original entrepreneurs and scientists, and helping create companies. And the unique thing about this strategy, which I think is differentiated, we've looked at a lot of groups in the biotech space, as well as Mercer, is given you're creating these companies from scratch, your basis is quite low. You can control the companies very carefully, think about capital over time as you're developing the IP to actual process, and actually have pretty low loss ratios. And I don't want to steal their thunder. They'll walk you through this, the Cure team. But it's a strategy with a lot of asymmetry, and you can actually control the loss ratios. One of the things that's even more surprising is, I think there's an assumption you have to take a drug all the way from the beginning process all the way through the FDA process. Oftentimes, given pharmaceutical companies are effectively distribution platforms now, they're looking for innovation in biotechnology. So when something hits a certain point, they're actually willing to buy these companies relatively to the life cycle. And you know, you look at the track record of this team I'm about to introduce you to. Actually, the holding periods are actually pretty low in their track record historically, less than 5 years, to give you a sense of the realized return, which is pretty incredible given some of the gross multiples that you've seen. So with that context, I'll pass it over to Richard to discuss some more detail.
Thank you, Chris. Good morning to you, Madam Chair, and to the members of the Investment Committee. Thank you for sharing our time.
Sorry, Richard. The other Richard, Mr. Pugmire.
Oh, sorry about that.
No problem. Thanks, Chris. We're presenting a commitment to Cure Ventures today. This fund is focused on early stage venture capital investments in the biotechnology healthcare space. And we've looked at the biotech space over the years because there's a sizable portion of venture capital investments that goes into this area. We've really been waiting for a team with the right approach and strategy that gets us excited, and also an experienced team to partner with. And Cure has 3 founders with a strong background in biotechnology, and all 3 are in the meeting today. Richard Lim was previously at Omega Funds, which is a strong biotech manager and also has business experience in the pharmaceutical industries. Lou Tartaglia has a scientific background with a PhD in biochemistry, and he has experience working for Millennium Pharmaceuticals in developing therapeutic programs, in addition to working with some other biotech funds in the space, including as a partner at Third Rock Ventures. And David Falacci previously worked with Polaris Partners and Alaska Permanent Fund, where he led direct investments in biotech companies. And they have overlapped on a few companies prior to forming Cure, so they have a background together. The strategy focuses on seed investments and therapeutic treatments that are really focused on large, unmet medical needs. And this is an area of growing need in the world as the population ages, and there's going to be needs to treat chronic diseases. The team has strong connections in the pharmaceutical industry, which is important to the strategy. And Cure also takes an active role from the beginning, from sourcing the technologies from research institutions to being an active manager the first year of a company's existence. And reference calls that we made were favorable about the team's relationships in the industry, and the team has a strong reputation among its peers. We also did quite a bit of work looking at the prior track record of the team, and all 3 founders have had success in companies that are realized at strong gross multiples of return. So given the strong team and their experience, the compelling strategy and success that the team members have had in prior investments, we're recommending an up to 35 million commitment to this fund. And with that, I'd like to turn it over to the three managing members of Cure Ventures for a short presentation, and then we'd be happy to answer any questions.
Thank you, Chris, and thank you, Chris, Richard and Chris. Good morning to you all. Thank you for sharing your time with us. As there are quite a few windows on Zoom here, I'll ask my colleagues to raise their hands and give a little wave so you know who we are. So the three of us, Lou, Dave, and myself, we are the three managing partners of Cure Ventures, a life science venture capital fund. Cure is investing in one of the largest and fastest growing segments of GDP, which is healthcare. Cure's fund employs a seed stage company building strategy with a heavy emphasis on de-risking throughout our investment process, all of which we'll touch upon. As Richard thoughtfully described for us, the founders here have built and realized some of the highest returning deals ever seen in the biotechnology sector on a consistent basis. The three founders here each come with strong individual track records in the biotech sector with a history of managing downside risk. The three of us lead a team of 9 partners, almost all with PhDs, each with decades-long careers as skilled operators as well as investors in therapeutic medicine development. Our colleagues have worked at companies such as AstraZeneca, Merck, Bristol Myers Squibb, Novartis, to name a few. We are most proud of our history in bringing almost 36 life-saving medicines through FDA approval to patients, addressing the scourges such as cancer, inflammatory diseases, and diabetes. As one of the co-founders, I am Rich Lim, and I've built my career in biotechnology spanning over 30 years. Though I initially trained as a chemist, my success is marked by finding great technology and working with visionary entrepreneurs to build from scratch valuable businesses that were either acquired by strategics or IPO'd in the public markets. I have a long history of successfully managing and growing investment firms, formerly as president of Omega Funds. I have known and worked with my colleagues here, Dave and Lou, for the bulk of my time in biotechnology. So I'll turn it over to Dave to introduce himself.
Good morning. I'm Dave Fallaci, and like Rich and Lou, I've dedicated my career to successfully investing in technology and biotechnology. I'm trained as an attorney and started my career as an institutional investor, also as a direct venture investor. I previously, as Richard had indicated, I had previously worked at the Alaska Permanent Fund and most recently at the venture capital firm Polaris Partners, where I focused on biotechnology. I got to know Rich and Lou initially because I was investors in both of their funds, in many of their funds, where we not only invested in their funds, but we looked at deals together and invested alongside each other. That's a little bit of my background. So Lou?
Good morning, everyone. I'm Lou Tartaglia. As Richard said, I was originally trained as a scientist with a PhD in biochemistry. I then spent the first half of my career in the biotech industry in operating roles. During that time, I had the good fortune of working and moving forward our understanding of diseases such as diabetes and obesity. I transitioned to become an investor in the mid-2000s when I joined Third Rock Ventures, and that was also at the time when I got to know both Dave and Rich well. During my 7 years as a partner at Third Rock and then 5 years at 5AM Ventures, I was privileged to help build numerous companies that pioneer technologies like gene editing and also develop medicines in diabetes, in diseases such as cancer, diabetes, and obesity. While most of us at Cure are trained as scientists and operators, we have a keen appreciation of translating what we know in science into medicines that help patients. We will speak more on this, but our secret sauce is to use developing analytical technologies and human genome sequencing to increase our batting average when it comes to successfully investing in biotech. In short, we are taking nature's own experiments in human genetics and using that knowledge to increase probabilities of success in new medicine development. Over to Rich.
Thank you, Lou. In the deck provided to you, we have described in detail the three elements of our strategy, but to summarize, point one, we focus on managing technical and financial risk by seeding deals with very, very small amounts of capital, tranching the capital in upon achieving milestones, and only then investing larger blocks of capital when we know the science is real and other factors are de-risked. Our track record shows that we've historically been very careful with capital deployment and only deploy large amounts when the data supports this. This has translated directly into very low loss ratios. Number two, we are company builders. And what this means is we take on the CEO, CSO, and other operating roles for the first year of a new company we create. In essence, running day-to-day management of our companies instead of using outside management teams. In consideration for taking on these roles, we split 50% of the initial common shares with the academic founders. This is at zero basis. Any ownership derived from our investment dollars is on top of these initial common shares. The element of our strategy, this element provides us with full control of the company and the lowest investment basis of any investor. This translates into very high ownership when we exit, which enhances our returns dramatically. Finally, our third point in our strategy, we have invested in an in-house platform that studies human genetics, something that Lou referred to, which helps us pick drug candidates with the highest efficacy, lowest toxicity, and the greatest chance of getting through the various clinical trials they face. Our investment in this particular platform that we've developed will increase, as Lou has described, our batting average, and we expect to do so consistently from fund to fund. Dave, a few comments perhaps?
Sure. So I'll comment a little bit more about kind of our team and what we do. So our team is comprised of highly experienced operators who will step in the early stages of a company's life to get it going and set its direction. So some of our team members have worked on some of the biggest blockbusters in like Keytruda of all time, some of the biggest blockbuster drugs of all time. Once the company is de-risked after running key experiments, we're best positioned to raise additional capital and hire a world-class permanent management team to take over for us. By taking on these operating roles in our companies, if the early experiments aren't working out and they're negative, we can shut the company down and reposition. We can always limit the capital exposed and deploy it towards stronger projects. We've done this repeatedly throughout our careers, and in our first 4 deals, we've executed upon this approach. This is a recipe for financial success and downside mitigation, which is one of our focuses. Lou?
We're highly sensitized to managing risk in science, and doing so requires not just experience and pattern recognition, but also taking advantage of the gift that mass genome sequencing in nature has given us, which is insight into human genetics. Through this, we can increase the chances that what we are seeing in the lab will translate and impact patients in the manner that was intended. By increasing efficacy, lowering toxicity, and picking patients best suited for the drug, this turns into higher hit rates and ultimately predictable and consistent returns to our LPs.
In conclusion, thank you, Lou. We're privileged to be here and serve you, our LPs. We in fact formed this firm, Cure Ventures, to put you at the top of the stack. We have also formed Cure Ventures to not invest in purely incremental technologies, but make a true difference in human diseases. We have done so repeatedly over the decades together, and with our strategy, which we have honed over these years, we will do the same for the state of New Mexico and for other LPs. And with that, I'm happy to take some questions.
Thank you, gentlemen. So next we'll go to questions from council members. I'll take the ones here in person first. Questions? Let's go to the Zoom council members. Questions for the team?
Madam Chair, if I could just interject, I misspoke when I introduced this particular segment. This particular recommendation, the committee sent it forward unanimously for the council to look at, but without a recommendation. The issue was the fact that this is a fairly large commitment in this program for a brand new operation without the kind of history we typically see, and that created some concern on the committee. I believe that my opinion would be that those issues were addressed pretty clearly by the three gentlemen who spoke to us. And but I wanted to make sure I let everyone know that the council sent this, that the committee sent this up without a direct recommendation.
Chair Love, if you don't mind me commenting on that, while this is a first time fund, this is a team with a long track record. They're experienced team that have done this before. What we're never going to bring you is a fund that's never done something before. And we want teams that are experienced and have track records doing what they plan to do. And yes, technically it's a new firm, but this is a team that knows each other, and they all three of the managing partners that we have long experience and frankly some of the best track records. And so,
thank you.
Our second time fund, you're going to see big tech opportunity. Similar idea. Firm,
Madam Chair.
track record. Yes.
Member Rawson.
Yeah, I'll just express my concerns, and I do think the presentation was thorough, and I agree that there is a good track record from the individuals from their prior roles. But the concerns I have here were, one, not only was it a new firm, but I thought the fees and the terms were quite high, as well as the low GP commitment, and then the SIC would be putting in basically 10% of the capital that's being raised. So it's kind of a combination of those four areas that give me cause for concern. Thank you.
So I'm wondering if Mercer wants to comment on the size of the commitment or anything else at this time.
Yeah, I mean, the fund terms, venture capital in general, fund terms tend to be more aggressive than other segments within private equity that you're used to seeing, more buyout type. We looked at things like the general partner commitment. I mean, a lot of the team's personal capital went into actually building out the organization, and so they are having a meaningful portion of their net worth in this fund, even though the percentage is smaller than what you may see with other funds that are more established or may even have a history of generating carried interest from previous investments as well. So we were comfortable with the terms as they were put compared to other funds that we've seen in the market in this space.
It would be appropriate if we might be able to comment as well on the question that was provided, the questions provided. Yes. So, Member Rawson, I think if I may address the management fee point that you made initially. So the company building model does require of us heavy operating roles as CEO, CSO, C-suite members, which leads to a very, very large in-house staff. We actually have 10 employees of the firm. For a fund of this size, it's actually very significant. And we intend to be between 14 and 15 members of the team at the end of the year. So unlike other firms, though, I'll be cut right to the chase, we will perform these functions internally, where these roles are serviced out from our staff, rather than hiring outsiders who would be much more expensive in our view to our investors in the long run. Important to note, economically, our roles enables us to justify getting 50% of the common shares of a new company, which importantly, and I will emphasize, every share goes and inures to the benefit of our LPs. This low basis and very significant ownership we have proven over the years with this model leads to very dramatic enhancement of returns to our LPs. So one other point, if I may, about the fee. We have this larger team whilst also maintaining discipline with regards to the fund size. For biotech venture, the performance data across the industry are very supportive that managing too much capital leads to underperformance. So the combination of managing discipline as well as the very heavy operating roles that we take, we are requesting justification of this management fee that we've asked for. With respect to the comment around the GP commitment, Richard Pugmire has described and made allusion to the fact that we are investing significantly out of our own pockets into the building of a platform. We are estimating it's going to be over $1 million a year from the partnership into developing this genetic validation platform. This is unseen in other venture funds who are taking their own fees and their capital from amongst the partners to invest. This will again inure to the benefit of our LPs, and this is then something that we just have not seen in other venture funds. So it's another support for the structure that we've built. And finally, if I make a comment about the team colleagues that we have here, we have built these companies over decades. I've known Lou since the early 2000s. We actually spent a lot of time working and completing investments around looking at deals in the metabolic space. Dave and I worked on one of the biggest deals ever, highly impactful in the CAR-T cancer space, Juno Therapeutics. We worked intimately well together in developing that company, which frankly speaking sets a new standard of saving the lives of patients with children with cancer. So we have over the years worked very closely with each other, and that those employees that we described, we've known them since the early 2000s. We're pinching ourselves that we are able to bring that quality team into this firm. So Chris Cassidy's point, while this is a first fund definitionally, we have known each other for decades. We know how to finish each other's sentences. We know how to get work done efficiently. And we actually share philosophically, which is why we came together, one very important piece, which is alignment with our LPs, putting the LPs at the top of the stack and the firm and the individuals of the firm below it. This is crucial to the culture that we've developed, but started many, many years ago when Dave, Lou, and myself got to know each other.
Anything further? All right, we appreciate that explanation, and it looks like we have a motion.
Yes, ma'am. Based on the recommendations of consultant Mercer, SIC staff, and general fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $35 million to Cure Ventures Fund 1 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second? I'll second. All right, we've got a proper motion here by member Lavender, a second by member Romero. Any discussion on the motion before the council? And I should have checked this before we started, but Andy, can you hear me?
I can. Thank you, Commissioner.
And we can hear you. So with no discussion on that motion, could we please have a roll call vote on the $35 million commitment to Cure Ventures Fund 1?
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Miss Allen,
Sorry, yes.
Mr. Bingaman,
Yes.
Mr. Lavender.
Yes.
Madam Chair, the motion carries 8-0.
Congratulations to Cure Ventures. That's amazing. Thank
We
you
are
for being
great.
with us.
Thank
We are
you.
grateful and privileged with this vote. Thank you so much.
Excited about that. All right. So with that, we will move to agenda item 3C, which is our Bain Capital Asia Fund 5 investments recommendation. And once again, turn it over to Mr. Cassidy.
First of all, thank you for that. I have a passion for biotech investing. I think it's really important. It's an important part of society that we, tackle these issues. So thank you for this. So Bain Asia, you'll know Bain from a number of investments we've made with them. We're bringing Bain Asia, which is part of their buyout platform. Bain raises a North America focused fund, a European fund, which we brought earlier in the year, and a Pan-Asian fund. And similar to what you saw with Bain Europe, Bain, one of the things I personally like about Bain is they really do have a global angle that is the lens that they have for the investments they make, whether in different regions around the world. It really gives them kind of an advantage relative to some other firms that are more just purely regional focused. Just to give some context, EM as broadly defined emerging markets is roughly 11% of the buyout index that I'm trying to replicate, 25% of venture capital, amazingly. It's probably not that well known a fact that venture is so large that we don't really have a lot of exposure on venture capital. Do have roughly an index-like exposure on buyout side to largely Asia. Latin America is a pretty small component within EM at this point. There's a number of firms who invest there, but it has not, given the immaturity of the region, it's not that big a part of it. We view Bain Asia as part of our global relationship with Bain. This is one of the world's great mid-equity partnership. It remains a firm that is 100% owned by the GP, the underlying people managing the money. They have among the highest GP commitments in all of private equity. It's interacting with them is like interacting with a true partner. And excited to bring this forward. Bain Asia itself has one of the largest and most stable teams in Asia, and one of the best track records. It's pretty significantly outperforming both public. Again, Richard Pugmire from Mercer will make some comments, but we're also joined by David Groslow, who's the co-head of Bain Asia's practice, and Steve Radakovich, who on the investor relations side. So Richard, I'll hand it over.
Thanks, Chris. Yeah, we're targeting a $50 million commitment in Bain Capital Asia Fund 5. This fund is a sought-after fund series in the Bain platform, and it's expected to be oversubscribed as it has been in the past. We have a target to Asian emerging markets in the overall strategy of the national program of 10% to 25%, which is another reason why we're targeting an Asia-focused fund. Bain Asia is part of the overall strong Bain Capital platform. Bain Asia was formed in 2006, and they now have 6 offices across Asia. And we think being part of a global platform allows them to tap into those synergies like sharing market knowledge and sector insights across geographies and industries, which seems to be more important in volatile markets like we're currently in. The Bain Asia team is a large team. It's led by 18 managing directors with 2 co-heads, one of which is on our meeting today, David Groslow. And this group leads a team of 83 investment professionals. And with Bain, one of the hallmarks of their strategy is their portfolio management group, which goes back to the consulting roots of the organization. Bain has a dedicated portfolio management group to assist portfolio companies on various strategic initiatives, including mergers and acquisitions, financing, and other management issues. From a strategy perspective, Bain focuses on multiple geographies in Asia, but they may allocate more capital to certain regions it has more conviction in, which has proven successful in the past, with Japan being one of the more successful countries. From an industry perspective, the fund focuses on technology, consumer, financial, and business services, industrial, and healthcare. And from a performance perspective, Bain has performed well in its last 3 funds in particular. The firm continues to have strong alignment with one of the larger commitments to the fund in the industry. And we believe that the Bain Asia is a good fund to add to the national program to help meet that Asia strategy target of 10% to 25%. With that, I'd like to introduce David Gross-Lowe, who's a managing director at Bain Capital, and he was also a founding member of the Asia business. He's been at Bain since 2000. And after his presentation, we're happy to answer any questions from the council.
Hello, nice to meet everyone and be here. Richard, should I start with a bit of an introduction? Is that okay?
Yeah, that'd be great.
Terrific. Well, thanks again, and we're very privileged and excited to be here. As Richard described, we've been on the ground in Asia since 2006. We're now raising our fifth fund. Our strategy in Asia has been kind of twofold. One is to build very deep local networks in each country. As you all know, the countries in Asia are very different. There's a lot of local dynamics specific to each country, and so it's critical that you have a significant amount of depth locally to be able to source deals. We focus mostly on proprietary deals, so 2/3 or more of our deals are exclusive discussions. Proprietary deals is different than maybe the auction situations that would be more prevalent in other parts of the world. And that's due to this deep local sourcing approach. The second dimension to this is, as people have mentioned, is our global approach. So we are Asia focused, but we sit within the broader Bain Capital platform, which benefits from a wealth of industry sector knowledge, of executive relationships, of experience looking at businesses that may be further along the development curve in the United States and Europe, which gives us very unique perspective when we look at those more emerging businesses, whether it's an undermanaged business in Japan or whether it's a growing business in India. We're able to size those businesses up, think about what their cost structure and return of capital should look like, and then which allows us to better analyze and evaluate the opportunities and risks. But importantly, we can pull from our global network executives, portfolio people on the ground to help support operations, knowledge of how to bring in best practices around supply chain, procurement, digital, whatever the key issue for the business may be. And so the global dimension is an incredibly important complement to the local depth. It allows us to be as local as a country fund, but have all of the resources and scale as a global player. And I think that's what has allowed us to differentiate ourselves in the market. The second key point I would emphasize would be this value creation approach. So in all of our investments, whether it's a controlled buyout investment or whether it's a kind of higher influence but minority investment, we're dedicating significant members of our own team who have operational training. These are people who would have worked at other multinational corporations, worked at consulting companies. Some are chief executives or chief financial officers in their own right. And we have these teams in each country. So Japanese nationals in Japan, Chinese nationals in China, et cetera, that can dive in and support businesses. This is really critical in all of the markets in Asia. Again, in Asia, the businesses tend to be a bit at the earlier stage of development in terms of their managing capabilities and depth, in terms of their adoption of best practices. So the ability to actually have the vision of what needs to be done, but then to be able to add people that can go do it is also quite unique. The final point I would make is that we truly do look at this from a pan-Asia lens. And so while we do have these country teams, our goal for this fund and as significant principal investors into this among the Bain Capital Partnership is to find the most interesting relative opportunities at the time. We're not looking to deploy capital, a certain amount of capital in India or a certain amount of capital in Australia. We're trying to find the best opportunities we can across all of these countries. The countries tend to be somewhat uncorrelated from a macroeconomic perspective, which gives us the opportunity to kind of lean into certain markets where we think it's a good time and lean out where we think there are potentially some more risks. And as a result, you've seen our mix of geographies and our mix of industries change somewhat significantly, vintage to vintage or fund to fund, because of where those opportunities lie. And that's what we believe is a huge advantage to managing some of the volatility that you might see in the Asia region. The upside part of it is that Asia is growing. There's a lot of interesting long-term secular growth trends that you're investing behind, but you want to be highly selective. You want to be very flexible to be able to invest when it's the right time in certain countries. And we've got a very disciplined investment committee process at the Pan-Asia level that sits across all of the activity at the country level to roll that up and to make top-down decisions on, where's the best place to invest in a particular time. So those are some key tenets of our strategy. I'll maybe stop there and pause and see if there are questions or areas where people would like to explore a bit more.
Thank you very much. So we will go to questions from council members.
Madam Chair, I might mention that Lee had brought up the issue of the concern about the investments in China based on the geopolitical situations we're seeing at the present time. Lee, do you have any further comments about that?
No, I just don't think it's prudent with the Chinese investment. Given all that's going on in the world right now, I think there are potential issues there. I do have a lot of confidence in Bain. That this was an ex-China fund, I would certainly think we should do it. But given everything that's happening in the world now, just security-wise, I don't know that from the asset security-wise, I don't know that it makes good sense. It's not a country that I have much confidence in.
Madam Chair, the committee at the time, Mike Messina and John Owick couldn't be there, and so it was Nick Tejas and Lee and I were there, and Nick and I both were, even despite the issues with China, were comfortable. So our recommendation was to move this forward for approval.
Okay, thank you for sharing that. Anything further?
Based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $50 million to Bain Capital Asia Fund 5 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I second.
All right, so we've got a proper motion from member Lavender. We've got a second from member Allen. Any discussion on that motion? Okay, if we could have Andy take a roll call vote of an up to $50 million commitment to Bain Asia Fund 5.
Commissioner Garcia Richard,
Yes.
Secretary Romero,
Yes.
Treasurer Eichenberg,
No.
Mr. Lavender,
Yes.
Mr. Rawson,
No.
Mr. Messina,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 6-2.
Okay, very good. Thank you very much. And thank you to Mr. Groslow for being on from Bain.
Thank you. Thank you very much. I appreciate your confidence in us. Thank you.
Okay, moving to agenda item 3D, Waterland, and I'm going to turn it back over to Chris for the last presentation.
So finally, this is a new relationship we're quite excited about starting. This is a very, very access constrained manager in Europe. They have among the best track records in the buyout space. It's a Pan-Asian manager that focuses on a buy and build strategy that's very value oriented and involves partnering with the original entrepreneur or founder of a business that's looking to grow their business. And Waterland assists in helping that manager grow his business, finding acquisitions. It's a very, very resource intensive strategy, but done well, and Waterland's done phenomenal over time. Has produced very, very differentiated and outstanding returns. To give you a sense, Europe's roughly 26% of the buyout index. We're roughly we index to that roughly, which is through a combination of global managers as well as managers like Waterland. We're incredibly excited to start this relationship. There's 2 fund series here we would be committing to. We're recommending a commitment of in aggregate of up to 75 million euros to one Waterland Private Equity Fund 9, which is their flagship strategy, and Waterland Partnership Fund 1, which is their follow-on kind of reinvestment strategy. I'm going to pass it along to Amy Ridge from Mercer to discuss in more detail, and we're also joined by Mark Lutkin and Frank Lyon from Waterland.
Great, thank you, Chris, and good morning to everyone. So as Chris mentioned, Waterland is a very top performing oversubscribed manager that we are excited about. They focus on pan-European investing. They have a focus on small and mid-market buyout investments, and they've been doing this for over 20 years, during which they've raised 8 flagship private equity funds, all of which have consistently generated strong performance. This would be a new European manager for you, but when we looked at your current European portfolio, we actually like this addition because they are going a little more upstream and finding smaller companies than a lot of the managers that are in your portfolio today. As mentioned, the flagship fund, they're also raising their new fund series, Waterland Partnership Fund. This fund is going to invest in the best performing investments where they think that there's an additional stage of growth to be had. We've seen this trend. We have talked about it in this meeting previously. We are seeing more managers realizing that once an investment has generated great returns and reached the life cycle in a fund and is ready to be sold, some of them really have a new stage of growth to be had. And so we are seeing more GPs doing this type of second fund strategy. As a new LP, you will be required to commit to both funds, but we got comfortable with this. The return profiles are actually complementary. So you have the main flagship fund. Typically, they're buying them at a smaller state, so it takes longer to generate all of the growth that they want to do. So usually that will result in a longer hold period, so a lower IRR but a higher multiple. And then you have the follow-on fund, which is typically has a shorter hold period, and so that fund is expected to generate a higher IRR but a lower multiple. So very complementary. Waterland has the capability to execute both strategies, so we are supportive of that. We do like the profile of the transactions that Waterland targets. So the management teams who are running the companies, they roll a significant portion of their ownership, which is great because that ensures that they're aligned, they're going to stick around, and they are going to be leading many of the growth initiatives that are going to happen within the company. So that's really important. Waterland has a huge team. They have over 100 investment professionals spread across 13 offices in Europe. And they are going to focus geographically across mainly Northern and Western Europe. They do have an operations team today. It's on the smaller side. So they have 4 people, but the firms recognize that they really need to grow this. And so they are very focused on it. They actually expect to have around 30 operations professionals in the very near future. So that's going to be greatly built out. There are some terms that are above average, nothing outside of what we'd expect, though, from such a top tier manager. And we really like because they have, the ownership is concentrated within the firm, which is really important. They have a strong GP commitment, broad dispersion of carry across the team, which again is very important for retention. So very long history, large, well-tenured team, consistently strong track record. And we are going to recommend up to a 75 million euro investment in Waterland. And with that, I will now turn it over to the Waterland team, Frank and Mark.
So thank you, Chris, and thank you, Amy, for the very kind introduction. We're very excited to be here. Frank unfortunately couldn't join, so I'm going to do the presentation on behalf of him. My name is Mark Lucian. I'm the head of investor relations at Waterland. We shared a presentation with you ahead of the meeting, but kind of just to add a few words to it. So basically, the firm was founded in 1999. We have got 10 funds under management. So it's 8 flagship funds and 2 single asset GP-led transactions. Now, AUM is currently above 10 billion. And when you look at it in terms of what is truly unique about us, is the number of acquisitions that we have done. So we have bought over 900 businesses since inception, and that breaks down in terms of 150 platforms, over 750 add-ons. There's no one else in Europe who has been, doing such a buy and build strategy the way that we have done it. To give you a bit of an idea, last year we bought 154 companies. Now we started in the Netherlands and then expanded into Belgium, into Germany, then further east into Poland, and then up north in the UK and the Nordics. And then over the last 3 years, we opened up Ireland, the second office in the UK here in London, France, and then also Spain. And basically, we are currently on the second generation. So the firm was founded by Rob Thielen, and in 2015, Frank Flyen took over as group managing partner. Now, to talk a bit about our strategy. So one thing that is really key for you to understand is basically, as we have increased the fund sizes, we have decided to do more deals rather than do bigger deals. So our funds are a lot more diversified than your average buyout fund. Now, we focus on mid-sized companies, and basically, our sweet spot continues to be companies with an EBITDA of 10 to 30 million. Now, we are investing into growing markets, so markets that are positively impacted by the following 4 megatrends: aging population, outsourcing and digitalization, leisure and luxury, and sustainability. The first 3 megatrends have been around at the firm since inception, and sustainability was added in 2008. Now, we are investing to markets that are highly fragmented with the view in terms of to consolidate them and build up a firm to be in the leading top 3 or top 5 players in that respective market. And for us, proactive deal sourcing is absolutely important. So basically, we often take a market approach where we look at the market, see whether that market meets our criteria, and then proactively kind of approach portfolio companies. With us, buy and build is key. So basically, on average, we do 5 to 6 add-ons per platform, but there are also kind of some very intense buy and builds that we run, where we do up to 30 add-ons. We are a control investor. We do sometimes do co-control with the founding family, and we are very hands-on, because when you put a company on such an accelerated growth trajectory, you need to be very close to your portfolio companies. And as you said, in terms of when it comes to the geographical split, we cover most of Europe with a particular focus on Northern Europe. You mentioned our strategy is very resource intensive. We are applying a local for local approach, which is necessary given the size of deals and the number of deals that we're doing. So we have got by now over 160 employees, including over 110 investment professionals across 13 offices in Europe. And that is kind of something we have invested a lot into the organization, and that is basically very key for our strategy, kind of just given the number of deals that we have been doing. Our biggest offices are basically in Belgium, in the Netherlands, and in Germany. But even the more recent offices already have 5 or 7 people. So it's very important in terms of that these offices also staffed kind of correctly. Whenever we enter a new market, we do that very thoughtfully. So we first start doing add-ons before considering whether to enter market, and then basically, start by hiring a local principal and building out the team. And then we're going to have a sponsoring partner kind of covering a new market. Now, in terms of team, the firm is owned by 12 partners. The partners have been with the firm for, on average, over 10 years. The senior team of the firm has been very, very stable. And we have also kind of expanded the level below partner in terms of with the principals, the associate principals. And so the firm is well set up in terms of being able to, to invest a fund of this size. And yeah, when you look at it in terms of the last kind of couple, the last 4 years have been record years in terms of deployment. And so we feel we have really built a deal engine. We've been very disciplined on our entry pricing, which I think we're benefiting from now. And so, we're also in a very fortunate position that there's a lot of LP demand for the two funds that we're raising.
There's any questions from anybody for Mercer or for Mark?
Council questions?
Madam Chair, this was recommended unanimously by the investment committee. Based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff in general, produce the oversight of IBK, and move the State Investment Council approve a commitment of up to 75 million euro in aggregate to Waterland Private Equity Fund 9 CV and Waterland Partnership Fund 1 CV, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
That's a proper motion. Do we have a second?
I'll second.
Okay, we've got a motion by member Lavender, second by member Romero, Secretary Romero. Any discussion on a motion to approve up to 75 million euro to Waterland in aggregate? All right, Andy, if we could have a roll call vote, please.
Commissioner Garcia Richard. Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Good. Before we move on to the next agenda item, I want to thank Mr. Luchin for being on with us. I'm not sure what time it is.
Yeah, it's okay. It's just before 6. So I want to say a big thank you for your unanimous support, and we're excited to kind of start our partnership with you.
Very good.
Thank you very much.
Sir. We are excited as well. And before we move on, I'm just going to take my leave of you all. I have a pending looming deadline in November that I need to get to, and so I'm going to pass the chair. I believe I can pass it over to Member Lavender at this time. Thank you.
Thank you, Madam Chair. Okay, let's move on to 3E, vote real return Macquarie. That'd be Keith Sobel and Townsend. Keith?
Great. Thank you and good morning, Mr. Chair. The content for this portion of the presentation begins on page 231 of your diligence board books. I'll be joined this morning by Seth Marcus and Stephen Hertenstein and Teddy Grudzinski from Townsend, and also from Macquarie by Mike Glascott, who's the managing director in private market relationship manager for this relationship, and Jenny Chan, who's an MD and head of portfolio strategy, and also constitutes 1/6 of the IC for this portfolio. We're here to recommend a $100 million commitment to Macquarie Infrastructure Partners 6. Macquarie at $146 billion in AUM in the infrastructure area makes them one of the largest infra managers in the world. This particular fund will follow a core plus to value add strategy that's focused on North American mid-market enterprises. The fund will target low double-digit net returns, approximately half from gross cash yield, and the remainder would be anticipated from capital appreciation. This is a re-up. It's the third commitment to the fund series and fifth to Macquarie more broadly. The GP seeks to earn its returns by acquiring businesses where they can drive EBITDA growth by focused execution of business plans that would include operational improvements and bolt-on acquisitions. Review of the track record indicates that the results of the portfolios and its predecessors are consistent with the investment approach more generally. First, I'd point out that the largest fraction of returns is driven by EBITDA growth. In several cases, that growth of EBITDA has been more than sufficient to offset some multiple compression from entry to exit of particular positions. Second, there are 4 prior vintages of this fund series that have realizations in excess of 50% of the portfolios, and those have, on average, gross multiples of invested capital comfortably in excess of 2.0, indicating the GP's ability to drive attractive exits. From a portfolio construction perspective, we like the fact that this portfolio will contribute to the overall diversification of the real assets book at SIC. In particular, majority of fund series investments have been in non-energy infrastructure, including areas like utilities, communications, waste management, and social infrastructure and transportation, and is relatively underweight with a relatively small portion of assets in midstream, where we're relatively heavy in the overall SIC portfolio. So we do like the diversification components of this strategy. Staff also likes the carry structure on the portfolio, and we think that it's likely to create less gross to net slippage than other structures that you would see in the marketplace. And then a final note, if you look on page 2 of the staff memo, you'll note that this commitment would put us ahead of capital deployment plans for the year on a gross basis, but we'd highlight that the MLP reduction from last month would, on a net basis, cause us to be squarely on plan for the year. With those comments on the table, I'll hand off to Seth for Townsend's underwriting.
Thanks, Keith, and good morning, everyone. So as Keith mentioned, we're here to recommend a $100 million commitment to Macquarie Infrastructure Partners 6. This is a re-up follow-on commitment. We committed $100 million to the 2 predecessor funds, 4 and 5. Those commitments were made in 2018 and 2021. And we also have an outstanding exposure of approximately $89 million each to Macquarie Asia Infrastructure Funds 1 and 2. Those are Asia-specific infrastructure vehicles, and those commitments were made in 2015 and 2018. It's highlighted in our memo, but the total exposure we have to Macquarie within our real assets portfolio is about 14%. And this is relative or in comparison to our 30% maximum. It is not our highest exposure, but it is near the midpoint of sort of our max. You'll recall that 10% allocation to real return with 80% to real assets. So 8% of the total fund is targeted to real assets. Real assets do consist in our portfolio of infrastructure, timber, agriculture, and energy. And as Keith mentioned, the majority of our commitments this year have been to the infrastructure sector, given the build out of our other more mature portfolios within the energy and ag portfolios and timber. So this would represent our 5th commitment this year, totaling $500 million versus our original target of $350. Keep in mind, this target is just a guide. We do overweight or underweight based on the opportunities that are available to us. This vintage has presented us with a lot of attractive opportunities with existing managers. All 5, pending this commitment today, of our commitments will consist of follow-on commitments to existing managers. And then, as Keith mentioned, there was the recent sale from the MLP portfolio, creating additional capacity for commitments. The fund basics, Keith kind of walked through. $7 to $8 billion fund. This is a similar sized vehicle to the prior fund at $7 billion. It is core plus risk orientation with low double-digit returns, with a significant amount coming from cash yield, with a focus on transportation, waste management, utilities and energy, social infrastructure, and lastly, digital infrastructure. Mostly, the fund will be invested in both U.S. and Canada, and has the ability to invest internationally up to about 20% in targeted geographies. Those targeted geographies really focus on both Mexico and Brazil. the reason I really like the fund and really this strategy for the portfolio is that Macquarie is one of the most experienced infrastructure managers in the world. So some may say that they invented the private infrastructure investment space with a massive privatization in Australia back in the 90s, and they've grown obviously since that time. They're organized into sector specialist teams. So I mentioned the different strategies. They have a utilities team, they have a communications, transportation, waste management, energy team. So they have very deep sector expertise in each of these strategies and deep industry relationships. So this really leads to a number of different sourcing advantages and also information advantage when it comes to creating value for their investments. The Macquarie funds do tend to be less focused on energy and specifically less focused on fossil fuel related infrastructure. Keith mentioned that we have a lot of exposure elsewhere in the portfolio, so a good diversification commitment here outside of those sectors. The return history for prior vintages is very good. Most funds are ranked either in the first or second quartile for the really key performance metrics, and that's with the exception of their Fund 4, I believe, which is still in the value creation sort of optimization stage. We anticipate that return to increase. Lastly, Fund 6 does not have any pre-specified assets, and based on the closing schedule here, we will benefit from a first close savings as long as we close prior to year end in the next 60 days or so. So all of that feeds into our positive recommendation on the fund. And really with those strengths mentioned and our commitment to the fund historically, we do further recommend adding this fund to the portfolio. So I'll pass it over to Michael and Jenny for their presentations.
Thank you, Seth, and thank you, Keith. I'll quickly turn it over to Jenny. Just want to say first, appreciate the opportunity to come back and discuss our ongoing partnership with the state of New Mexico in Macquarie Infrastructure Partner 6. I've asked Jenny to walk through the strategy, review the opportunity, touch a bit on process and experience. So again, appreciate the opportunity, excited to be here, and we'll turn it over to Jenny.
Thank you, Mike. Thanks, Keith, Seth, for the introduction, and good morning to the New Mexico State Investment Council. So in the next few minutes, I will provide a brief recap of our fund and strategy in North America. You should hopefully have the materials that Keith referenced. I think it's starting on page 231, and I'll start at 235, which should be titled Macquarie Asset Manager. So as both Keith and Seth alluded to, Macquarie Asset Management is a leading global asset manager in multiple asset categories. Today, we manage over $500 billion in assets under management, and we are the largest infrastructure manager globally, having invested in more than 160 portfolio companies. As Seth alluded to, we have also been active in the market for a very long time, having started our practice over 20 years ago. Turning over to the page titled Macquarie Infrastructure Partners 6, in the Americas, our flagship strategy is executed through Macquarie Infrastructure Partners series of funds, or MIP as we call it. This is a North American focused fund, which makes us a little bit different from the market. So we have a regionally focused model with the US-based team focused on local opportunities. It really provides the best of both worlds in many senses by giving us access to local market knowledge, but the ability to leverage the broader team as needed. For MIP, we are looking to build a diversified portfolio of core plus infrastructure assets in the 5 key sectors that you see on the page, in which both Keith and Seth reference. And we are targeting a double-digit net return, so 10 to 12% net IRR, which is also very much focused on capital protection. Our team, with which Seth referenced, is a large team, so a team of 90, highly experienced, and they come to us from both industry and finance, which has supported our origination and asset management efforts over the years. So by and large, with this team, if you have access to the private materials, you'll see we have been very successful in both deploying the capital and achieving our target outcomes over the last 20 years. Maybe drilling more into the strategy, which is set out on, I think it's page 237, we are looking for a diversified portfolio. So in both MIP5 and for MIP6, we're targeting 10 to 15 investments, predominantly in the US and Canada, but with a small sleeve for Latin America. We are targeting 5 sectors, so high quality businesses in transportation, digital, waste management, utilities and energy, and social infrastructure. So think assets like toll roads, seaport terminals, fiber and internet businesses, waste businesses, and power companies. The nature of these businesses, because they provide essential services, really means that they have relatively stable demand. They're typified by large tangible assets, enjoy high free cash flow conversion, and also typically offer a good inflation hedge, having the ability to pass through increases in costs either contractually or because of their market position, all of which translates to relatively stable business performance. Beyond the label of the sector, we are also looking for a portfolio of investments which isn't relying solely on GDP growth, which is particularly important in the current economic climate. So we want some businesses in our portfolio where earnings may grow because of industry tailwinds, like in our digital businesses, or others which have accretive capital investment opportunities, like our waste businesses. This really dovetails with our thinking on value creation, which Seth touched on earlier. So we're looking for earnings growth to drive value growth. So we want diversified growth levers at the portfolio level. And then at the individual asset level, we also want each of the businesses to have different ways to grow over time. This can be organically through pricing, volume growth, cost out strategies, or inorganically through bolt-on investments. So in effect, what we're doing is creating multiple shots on goal at each asset to grow earnings and also at the portfolio level. And in this way, we create value while also providing downside protection. Lastly, I'll just touch on leverage. We're generally quite modestly or moderately leveraged. So across the portfolios, we have been typically at crossover credit quality, straddling a BBB or a BB credit rating, and between 30 to 40% debt to overall value. So this allows us to create efficiency in the balance sheet and optimize returns, but our businesses remain quite flexible through a range of economic scenarios. I won't spend time on the next 2 slides, which speak to the infrastructure opportunity set, which in shorthand, it remains quite large, and talk to more detail in our sectors. But I will turn to page 239, which just touches on the history of the MIPS in North America. So as you can see, this is a strategy that we've deployed successfully for nearly 20 years. And MIP6 is actually our 7th vintage in the series of funds, with the first vintage having a different name. I would highlight that we are one of few managers that have had that length of experience, and we've had the opportunity to manage assets through the cycle. We have invested in over 40 portfolio companies and have successfully exited out of half of these. We are probably one of the few managers, if not the only manager, that has 3 fully realized funds in its track record. And as Seth touched on, it has been a successful strategy for us, with recent vintages performing ahead of target returns. Perhaps to bring this strategy to life, in the last page on our deck, we have a map that shows where we've invested across the funds. And over time, where we've invested really depends on the available opportunity set. But the punchline on the page is we have been consistent in building diversified portfolios across and within vintages. It's worth noting that we have differentiated expertise as a manager, including being an early mover in the digital space, having invested in towers since 2007. We're one of few managers who have successfully invested in waste over a long period of time, and we're the largest private owner of seaport terminals in North America. So a truly diversified and consistently diversified strategy. By way of update, we are now over 75% invested in MIP5, and we expect to be fully deployed shortly given a pending transaction, hence our current dialogue around MIP6. And as an update, we have in fact made our first investment for MIP6 in the waste space and are actively pursuing a number of other transaction opportunities. We look forward to continuing this approach, targeting diversified core plus infrastructure assets. And I would like to conclude by saying, on behalf of Macquarie, we thank you, New Mexico, for your prior support on our earlier funds, and we would love the opportunity to continue the partnership that we have established to date. With that, I'm happy to open up to questions.
Thank you. Are there any questions from the council, either on the screen or in the room? Again, this was unanimously recommended by the investment committee, and member John Bingaman is going to make the motions from henceforth, so that I don't have to talk so much. So, John.
Sure, Mr. Chairman. Based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million in Macquarie Infrastructure Partners 6, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thanks, John. Do we have a second?
I'll second.
Debbie, seconded by Debbie. So moved by John, seconded by Debbie. Any further discussion? Andy, would you please call the roll?
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Mr. Lavender,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Ms. Allen,
Yes.
Mr. Bingaman.
Yes.
Mr. Chair, the motion carries 7-0.
Thank you very much. Thank you, Council. Thank you, Seth. Thank you, Keith. And thank you, Macquarie, for taking time to be with us today. Good luck. Make us some money.
Thank you.
Let's go on moving to 3F, non-core fixed income, Tom Lofton and Axia.
Thank you, Chair Lavender. Can everyone hear me okay?
Yep. Yes.
Okay, great. So private credit, last in line today, but hopefully not least. We are going to present two private credit commitments today. And frankly, given where we are in the macroeconomic cycle and the market stress, it's an exciting time to be in fixed income in general and private credit in general, certainly to be able to invest through strategies like today that seek to be senior in the capital structure with attractive risk-adjusted returns. So with that preamble, we're, I think as Chair Lavender mentioned, we're agenda item 3F. This is going to cover pages 307 through 393 of the materials. Brookfield Infrastructure Debt 3 is the title. So joining me today from Axia, Trevor Jackson and his team, and also from the manager for this commitment recommendation, Brookfield Asset Management. We have Chris Harris, Managing Director, and our point of contact for the SIC relationship. And we also have Hagley Pierre Marshall on the line. Ms. Marshall is a Managing Partner at Brookfield. She's co-head of the Americas investment team, and she's also a portfolio manager for this strategy. In New Mexico SIC staff, in consultation with Axia, recommends a commitment of up to $150 million to Brookfield Infrastructure Debt Fund 3, what I'll refer to as Bid 3. Bid 3 will invest in debt financing for high-quality infrastructure assets that offer essential services, similar to the Macquarie Fund, except we're going to be more debt market focused. This fund also will have a global footprint. This is a re-up. SIC previously committed $125 million to Bid 2. all the bid series, bid 3, managed by Brookfield Infrastructure Partners, which sits within Brookfield Asset Management. Brookfield Asset Management is a publicly listed company. They're an established name in the global infrastructure world. Their history date backs, I think, more than 100 years as both an owner and an operator. And similar to Macquarie before, they are a proverbial 600-pound gorilla in the global infrastructure space. Some of the reasons that staff views this favorably: first and foremost, the scale and industry expertise within Brookfield. Brookfield has over 45,000 operating employees in 5 countries. So they have a strong internal operating base for underwriting. Bid 1 and bid 2, the 2 prior in this series, have no impairments to date. I think that speaks to their underwriting discipline. Also their track record, and that they've performed ahead of their initial return targets as well. Probably the key fit within the credit portfolio is just the diversification as we seek to diversify our underlying assets. Infrastructure finance does offer diversifying exposure relative to both traditional corporate and consumer finance that you tend to see sort of dominate credit. And then finally, the alignment of interest. Brookfield is committing up to $500 million of its balance sheet to bid 3. The target net IRR for this strategy is 7%. The investment term is 10 years, initial 3-year investment period. This fund will invest globally. This commitment would invest through the US dollar sleeve of bid 3, which will have primarily US dollar denominated investments, with any non-US dollar exposures hedged back to US dollars. So in summary, staff believes that Brookfield Infrastructure Debt Fund 3 does offer an attractive opportunity for the private credit portfolio as a lending strategy. We are recommending an allocation up to $150 million be approved. So with that, I'm going to turn it over to Trevor Jackson for Axia's thoughts on the strategy. And then finally, we'll end with a brief presentation from Brookfield.
Thanks, Tom. Morning, Madam Chair and council members. Tom did a nice job of kind of really segue into Brookfield. I'll give a few comments before I turn over to my colleague, Phil Malarick, as well as Charlie Thompson, who's available on the ODD side if there's any questions. I think the biggest thing is that you've got a fund that, it's a re-up, well-known firm, globally positioned in a number of sectors in infrastructure. That's including energy, that's including data centers, that's including utilities. And so it does offer a fair degree of diversification in your portfolio. We talked about earlier in the year of having more assets in the ground and putting things to work, and we pretty much didn't have as many lending strategies, and so this kind of fulfills that bucket. And you've got a pretty healthy number so far through this year with prior commitments we've made. So I will really pause there and turn over to Phil to kind of walk through the strategy. Phil?
Thanks, Trevor, and good morning, everyone. So echoing some of the previous thoughts, we think Brookfield is pretty well positioned within infrastructure debt, and for this portfolio, it's a very well-resourced GP that we think highly of, just given the general synergies across the firm and its broader private equity capabilities and asset operating experience. We also think the debt team is well-resourced and highly credible. And so definitely a strong kind of culture and team with respect to the fund. The fund will focus on control positions in the significant majority of investments, which gives them, good kind of negotiating power. They've been able to structure fairly solid debt structures and bespoke covenants and step-in rights in the majority of facilities in the previous funds. So we view that in a positive light, particularly in this environment, in this macroeconomic environment. In terms of the market opportunity, we continue to view this as attractive for infrastructure debt, just given the contracted nature of the underlying cash flows, being senior secured in the capital structure, and the inflation protected nature of the underlying real assets. In addition, we are seeing increasingly larger borrowers accessing private capital as banks have stepped away and capital markets have shut down in recent months. And so we view that as an ever increasing opportunity for private lenders in this space. And in addition, there has been a lot said about the infrastructure funding gap, both in the US as well as globally. And so we see increasing opportunities to provide debt capital in the infrastructure space moving forward. On portfolio performance, the GP has performed in line or better than expected so far through current vintages. COVID-19, there are no instances of restructuring, enforcement, or credit impairments. So performance has definitely been in line with our expectations. Generally for the fund, we expect limited development risk, limited exposure to non-OECD geographies, fairly diversified portfolio across a variety of sectors within infrastructure. And then last thing I would point, echoing Tom's comments, is the alignment of interest here is relatively strong, with Brookfield making a large commitment to the third fund alongside LPs. So overall, very positive on the opportunity. Now, happy to hand it over to Brookfield for their comments.
Thank you. Hopefully you can hear me. As mentioned, I'm Hadley Pierre-Marshall, and I co-head the strategy. And in fact, I had the honor of presenting to you about 2 years ago for bid 2. We're excited to have the opportunity again to present bid 3. And just to remind you, as you've heard already, this bid 3 does encompass the same strategy we set up 7 years ago for both bid 1 and bid 2. First, I'd like to thank the staff and its consultants, as we are grateful for their support. We at Brookfield have had about 10-year relationship with New Mexico State Investment Council and are excited to have the opportunity to continue building that relationship. In addition, we are proud to be a long-term corporate citizen of New Mexico with approximately $600 million of assets under management. This includes our investment in Genesee and Wyoming, our rail investment, and 4 megawatts of solar, including one located at the Santa Fe wastewater management facility. Given the fulsome presentations by your staff and Axia and the request to keep my remarks on the short side, I thought I would open up to any questions, but again, would like to thank you again for your support.
Are there any further comments or questions from the council or anything further from Trevor? Okay.
Nothing from Axia.
Thanks, Trevor. The investment committee recommends this unanimously. So if there's nothing further, John, would you step in, please?
Sure, Mr. Chair. Based on the recommendations of the Council Investment Committee, consultant Axia's SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million to Brookfield Infrastructure Debt Fund 3, LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and a completion of appropriate paperwork.
Thank you, John. May I have a second, please?
I'll second, Mr. Chair.
Seconded by Debbie. Any further discussion? Hearing none, would you please call the roll, Andy?
Secretary Romero,
Yes.
Treasurer Eichenberg,
Yes.
Mr. Lavender,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Miss Allen,
Yes.
Mr. Bingaman.
Yes.
Mr. Chair, the motion carries 7-0.
Thank you very much, and thank you, Trevor. I know we're going to hear from him again in just a minute, and thank you, Brookfield. Hadley, thank you, and good luck. As I said before, make us some money.
Will do. Thank you.
Moving right along, let's move to the last voting item in this segment. Tom, if you'll take it back over again, please. You and Axia talk about Silver Point.
Will do. So this agenda item 3G covers pages 394 through 463 of your handouts. Silver Point Specialty Credit Fund 3. For this again, as Chair Lavender said, Trevor Jackson and his team at Axia are joining me. From the manager, Silver Point, we have Eve Teisch. Eve is a partner with Silver Point. She is our point of contact. And we also have Ed Millay. Ed is a founding partner for Silver Point. He's also CEO, and he's a portfolio manager for this specific strategy that we're recommending. So in consultation with Axia, staff recommends a commitment of up to $150 million to Silver Point Specialty Credit Fund 3. I'll call it SCF3. Silver Point focuses on investing in specialized and distressed situations and dislocated markets. This firm manages approximately $18 billion distributed across a few different strategy types. They have a hedge fund, they have a distressed closed-end fund, and they have the specialty credit fund series that we're speaking about today. SCF3 is the latest in the specialty credit fund series. This is a re-up for the SIC. The SIC has previously committed $100 million to SCF2. SIC also has investments in 2 additional Silver Point strategies, as highlighted in the staff memo. That would be Silver Point Capital Fund, as well as the Silver Point Distressed Opportunity Institutional Partners Fund. The SCF series, so we have a lot of experience with this manager. This series is going to focus on direct lending primarily in the U.S. But as I mentioned earlier, they're also going to, sorry, I got a little off script here. They're going to focus on direct lending primarily in the U.S. And they're going to focus on loans originated to middle market corporate borrowers. This would be an EBITDA range of around $100 to $300 million annually. As I mentioned earlier, importantly, the fund is going to have flexibility to opportunistically pivot across a lot of facets of the corporate lending market. Areas such as secondary market loans, what one would call hung syndications, bank syndications that they can't get off the ground, rescue financing, and even hard asset lending opportunities as those markets show signs of dislocation or stress. Certainly, there's multiple facets to diversification, whether it be asset type, strategy, manager diversification, investment period or vintage diversification. But staff believes that allowing opportunistic flexibility really enhances our strategy diversification in the private credit portfolio. And importantly, it allows the private credit portfolio to tilt, or some would say flex, quickly on its own to take advantage of market opportunities. So currently there is quite a bit of stress across the fixed income markets. And staff thinks that SCF3 is going to be well positioned to take advantage of that. One of the key, I'll just point out one really what I think is a key strength for Silver Point, is that Silver Point maintains fairly significant resources devoted to structuring and documentation for position protection and dedicated restructuring, which gives Silver Point and the team leverage into proactively manage their positions and protect their positions in special situations. So as expected for a strategy that includes distressed and special sits, the SCF series transactions, they do typically have higher levels of risk compared to what you would call regular way or normal middle market transactions. And reflecting that, the net target return on this strategy is about 300 to 400 basis points above what you would typically see for rates of return for the normal middle market transactions. The target IRR for for this fund. 3 is going to be 11 to 14%. The investment term is 5 years with a 3-year investment period. The target size for the fund is going to be $4 billion. It is larger than Silver Point's prior funds, but it's not out of line considering the 18 billion that they have under management. This fund is going to be US dollar denominated, and it will employ modest leverage, about 1 time at the fund level. In summary, staff believes that SCF3 offers an attractive opportunity for the private credit portfolio as an opportunistic lending strategy, and staff recommends allocation of up to 150 million be approved. So with that, I'm going to turn it back over to Trevor for Axios thoughts, and then we'll end up with a brief presentation from Silver Point.
Thanks, Tom. One of the big things for us when we think about portfolio construction is the ability to pivot and have opportunity set that is wider. And really, Silver Point really does a good job of that. If you think about what we did earlier in the year, we've done some real estate, we've done, just now infrastructure, we've done some distress straight out. And so the ability to have direct lending, middle market loans, but the ability to kind of, pivot as needed, as Tom mentioned, is incredibly interesting when we think about the market of volatility. We don't know what the next year looks like. So a manager that like this really fits in nicely because they can move whichever direction the market tends to go. It's higher octane in your portfolio to balance out some of the kind of more moderate names from a conservative return profile. So it really just fits from a portfolio construction standpoint. And when we think about, we had a target of roughly 900 million in investments for 2022, and we're going to really blow through that just because we're seeing a lot of opportunities in this particular marketplace. So I'm going to pause there and turn it back over to Phil to kind of walk through this strategy.
Thanks, Trevor. So in terms of Silver Point specialty lending, there's several things we really like about the potential for this re-up, particularly in this environment where we've seen a good amount of macroeconomic stress over the last several months. I think it lends itself well to the fund's opportunistic mandate. Obviously, the team has a very large and strong footprint in the middle market, particularly for more complex situations where we've seen pricing, increase quite a bit over the last several months. In addition, they also have the ability to purchase traded debt on the secondary market, the ability to step into situations where public markets are closed and larger borrowers need an alternative to bank financing or CLO financing, or even in rescue finance opportunities like we saw the team capitalize on after the GFC. In addition, I think there are significant synergies across the firm that are important to note here. The restructuring expertise, as Tom mentioned, related to the hedge fund, the distressed drawdown funds, I think is extremely relevant here, where the team is highly experienced in handling downside scenarios and working through, different lender situations. And we've seen, followed them for years on the hedge fund side and seen very strong performance there, as well as a long track record on the lending side, dating back to 2003, 2004. In addition, the broader organization does add other capabilities, including the sector specialization of the analyst team, which we think adds significant value on the investment side, and contributes significantly to the themes that they focus on the private lending side. In addition, sourcing capabilities, I think, are a differentiator here relative to other middle market lending firms that we've seen in the market that simply don't have the capital markets expertise and relationships to source similar deal flow, particularly with respect to larger borrowers. And I would just leave a final comment similar to the Brookfield situation. I think alignment here is very, very strong. The GP has typically committed significant capital to the funds alongside LPs. And so, overall, pretty excited about this re-up. But I'm tossing it over to Eve and the team at Silver Point for any comments that they have.
Thanks, Phil. I think Ed's going to do the introductions and remarks, and then we'll be here for any questions.
Great. Thanks, Eve. Good morning, and thank you all for your time today. First, I wanted to say that we value our longstanding relationship with the New Mexico State Investment Council. We appreciate your continued support of Silver Point through your allocation to Specialty Credit Fund 2, and additionally, your investments in our flagship hedge fund and the Distressed Opportunity Fund. We're pleased to have the opportunity to present to you today and give you an introduction to the next specialty lending vehicle of its series, Specialty Credit Fund 3. What I'd like to do today is to provide you first with an overview of our lending strategy, then talk about our experience in the space, and finally talk about the current environment and how our platform and comparative advantages position us well, particularly in light of the increasingly attractive opportunity set to successfully generate very attractive risk-adjusted returns for our investors. My partner Bob O'Shea and I founded Silver Point in 2002. Our goal was to build a global credit platform with a focus on areas of the credit markets with complexity and barriers to entry. That strategy has remained the same since inception. We seek out areas of the market that require deep fundamental credit analysis and focus on downside protection, which we believe drives attractive risk-adjusted returns across credit cycles. Today, we're managing approximately $17 billion in assets across 3 credit products. When Bob and I were running credit and special situation businesses together at Goldman Sachs in the mid-1990s, we saw that if you had the ability to source, analyze, underwrite, structure, and manage loans, you could be a provider of capital to companies where there was reduced competition. You could charge a premium compared to traditional sources of financing. And importantly, you could structure the loans with enhanced downside protection. Our specialty lending strategy is a continuation of that strategy. We believe the specialty credit strategy is extremely synergistic to our other products, and being part of a large global credit platform provides the lending business with many advantages. Our specialty lending strategy is a par origination strategy targeting direct lending opportunities to middle market companies. We strive to lend to stable, market-leading businesses with strong reasons to exist that are well-positioned to weather economic downturns. We target secured floating rate debt with attractive loan-to-value profiles, 90+% having been in senior secured loans that are primarily first lien $1 debt. We seek to structure our loans with strong downside protection through bespoke documentation. We seek to lend to companies in the range of $30 to $150 million EBITDA, and in deal sizes of between $100 and $300 million, as we believe this tends to be an underserved area of the market. Since 2003, we've successfully originated and managed over $17 billion of investments across 385 self-originated loans, and we've managed these portfolios through multiple credit cycles, including the global financial crisis. To date, our middle market lending strategy has performed very well, generating a 13.6% net IRR. We are raising Specialty Credit Fund 3 as we seek to continue to build upon the success of Funds 1 and 2. But we also believe the current macro backdrop has led to an increasingly attractive opportunity set. With a significant slowdown in the CLO market, consistent mutual fund outflows, and the fact that leveraged finance departments at large banks hold on their balance sheets large amounts of leveraged credit exposure for underwritten but unsyndicated deals in the public markets, those public markets are essentially closed to new issuance, and companies that have a capital need and cannot wait will be forced to seek a solution in the private markets. We see the absolute risk-adjusted returns increasing for us in the private lending space. Base rates are increasing, and the potential for further rate increases remains as inflation concerns are persistent. With uncertain public markets, borrowers have significantly reduced access to liquidity, shifting the balance of power more in favor of the lender from the borrower. This leads to increased spreads, hopefully greater OID, and importantly, stronger call protection, protecting lenders against duration risk. Finally, we are also able to target even higher quality borrowers and demand even stronger documentation, which can sometimes be an underappreciated element of the risk adjusting side of the risk return equation. In light of the current market environment, We feel that this is exactly the time when you want to have dry powder and that we are uniquely positioned to take advantage of the opportunity. We think when done well, middle market lending is a very attractive risk-adjusted returning strategy. But given the macro backdrop today, it's even more attractive for someone like us. We're excited about the launch of Specialty Credit Fund 3. And again, thank you for your time today, and we're happy to answer any questions you may have.
Any questions from in the room or on the screen? Hearing none.
Mr. Chairman, John Bingman.
Yes, hang on one second, John. This was recommended unanimously by the investment committee. John?
I just had a question related to the current interest rate environment and the use of leverage at the fund level. I'm looking at the Axia presentation, and there's a cost of debt assumption of 5.75%, and I'm just wondering, is that sort of still realistic in terms of the fund level leverage, or so maybe that's a question for Axia, and then maybe for Silver Point, how do they think about availing themselves of fund leverage as interest rates are bouncing around so much?
Yeah, I can make a quick comment and pass it over to Silver Point. We made some conservative assumptions around the leverage facility for the fund, just given the rise in base rates to the extent that it wasn't already in place. So we certainly seen base rates move a bit, and so that could potentially put some pressure on the leverage side. But keeping in mind that at the end of the day, the loans in the portfolio are generally all floating rate, and the fixed rate exposure is generally short duration in nature. So it shouldn't, affect sort of the net return at the end of the day too much. But happy to pass it over to Silver Point if they have any other comments.
Yeah, no, I would agree with that. As long as you're using the same LIBOR in your loans as you are in your financing sources, then if LIBOR turns out to be higher, actually your portfolio returns a little bit more because it is levered, but your cost of funding just floats effectively with your loans. And given that Specialty Credit Fund 3 is not yet investing, any fixed rate exposure that we would have in it, we would be taking that into account in terms of what the interest rate risk was if we were to enter in any fixed rate exposure in today's market. We have historically, because they were short, as mentioned, they were short duration loans, but where we've shifted a lot of those more recently to floating rate.
Okay, thank you.
Any further comments or questions? John?
Sure. Based on the recommendation of the Council Investment Committee, Consultant Axia, SIC staff, and General Fiduciary oversight of RBK, I move the State Investment Council approve a commitment of up to $150 million to Silver Point Specialty Credit Fund 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, John. May I have a second?
Second.
Someone said, up on the screen. Thank you.
Kathy. Yeah.
Oh, Kathy. Okay. Thank you. Appreciate that. We got a motion and a second is there any further discussion? If not, Andy, would you please call the roll?
Secretary Romero.
Yes.
Treasurer Eichenberg.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Mr. Chair, the motion carries 7-0.
Thank you very much. Thank you, Tom. Thank you, Axia. And thank you, Silver Point team. Good luck.
Thank you.
Moving right along.
Thank you.
Yeah, you bet.
Mr. Chairman?
Yes.
Before we leave this section, could I? make
Oh,
a
yes.
comment?
Okay, Vince, please.
So thanks again for the votes on these. Chris made that point earlier. I just wanted to back that up from a top down perspective. These 5 investments all are in areas that we've been focused on the last few years, or last several years actually. Private equity was 8%. Several years ago, we're at 13.5%. Real return was 0 several years ago. We're at 9.25% now. Non-core fixed income was 0% several years ago. We're 11.5%. So we've taken 8%. What areas that we had 8% of the portfolio invested in, we're now invested at 34%. That happens fund by fund, just like you see on your page here. So thanks a lot for the votes that you've made. These are the highest performing asset classes in the portfolio right now. And it's been that's been some of these asset classes that have kept us in the top half against our peers, and some in the top quartile.
Thank you, Vince. I appreciate that. And I think that I would just to echo what you just said, the fact that we've continued to perform the way we have is significantly related to these investments. So thank you for the team for bringing that. Moving to paragraph 4, finance matters. I kind of shortchanged you last time, Brent, but I'm going to give you plenty of time today. Would you take over?
Sure. Mr. Chair, I'll be super brief with my comments today. I just, as I always do, included the year-to-date budget schedule. I've gotten a few questions regarding the budget's savings that I've gotten a few questions in the past on the budget savings on the far right-hand column, which you're seeing now through the end of September. I just want to point out again that we're only a quarter through the fiscal year, so things can develop. We have been getting increased inflows, as everyone is aware, but those increased inflows are dampened a little bit by the negative returns that we're seeing in the market. So because of that, that's impacted the budget savings. And I would see at this point in time, much of that savings to carry through year end, unless the market just takes off, which I don't think we're anticipating. And then other than that, I want to go back to the prior page. And I just wanted to point out on item number 4, there is going to be an exit conference with Moss Adams. This is for the audit that's currently underway. It's probably going to be somewhere in the 3rd week of November. If anybody here is interested in attending that exit conference that hasn't been in prior exit conference, please let me know and I'll make sure that you get the information. We're probably 4 or 5 days behind where we want to be right now. I know I had a discussion with Moss Adams, who will be in the building tomorrow. They're hoping to kind of move up the deadline for the exit conference into the 2nd week of November. I'm struggling with thinking that we're going to be there as far as completion of the audit. The other thing I wanted to point out, as I've done in the past when it concerns the audit, one of the biggest things that we do for the audit, and this is for every fiscal year, is, and you might wonder why we're not sooner with the audit, we catch up the 90-day lag on the private investments. To be able to do that, you have to wait for those marks to actually get through the end of September, and then we get the information from the funds. So that's probably the biggest thing that we do for the audit, in addition to the implementation of GASB 87 this year, which relates to leases. I think we're probably okay on that. But if anyone wants to attend that exit conference, let me know. And then lastly, on page 538, I think Steve pointed this out. I went back and actually I thought we had a higher one. This inflow from the state land office this last month is a record breaker. So we're very happy with that. The question always arises as to what we see in the future. I'm hoping to gather some additional information, maybe from the land office and others, on what we're anticipating over the next year to 2 years. These inflows, the only thing I can say is I'm having a hard time thinking that they're going to continue to grow at the pace that they've grown over the last year. So be mindful of that. Other than that, I'm open to any questions that anybody might have.
Debbie.
So more, a little bit of questions, some comments. And so I noticed in your budget, you do have a significant amount in your personal services. So what and I heard earlier the discussion about salaries and compensation as an issue. And so I think we're looking at your budget and thinking about the environment that we're in right now. I think there's opportunities for you to look at what you can do both internally and externally when you're trying to hire people to make those adjustments to the budgets. Especially because you have that flexibility, you have the budget there, you have significant amount of budget in there. So I would recommend that you take a look at that. The one thing that I would ask you to compare it to is in the governor's executive budget recommendation every year, she has to, there's a part in there that's about the governor's exempt salary plans. So as long as you line up those positions with the salary plan and stay within those ranges, I think that you do have opportunity to make adjustments and to hopefully address some of the issues that you've been talking about. So that's number one as far as the budget. And I just lost the talk to you. What was the last thing you were talking about? Not the audit.
The inflow from the land office?
Oh, the inflow. So one of the things the FA does is we work with legislative finance committee, and we have, the consensus revenue group. I think you probably want to reach out to them because they are the ones that really track what the oil and gas revenues for the state of Mexico. They're the ones that put together the revenue projections for the budgets. And so they're keeping their finger on they have, they know exactly what's going on as far as the oil and gas and the inflows that are coming into the state. And so we have another presentation coming up in December. We'll be doing an update. We did one in August. We'll be doing an update in December. So they're working these numbers continuously. I'm happy to say that, I'm proud to say that the economist for DFA happens to be, in my opinion, the expert when it comes to oil and gas. That's his background. And so he's got a really good feel for what's going on in that industry. And he has resources that he uses. RISTAT is one of those resources that he uses to keep track of what's going on with oil and gas and the inflows. And he's, we've been talking about, we think it's going to peak at 2030 for months now. So I think we just need to loop you guys into that process or get you connected with that group so that you are more in line with what's going on with the revenue expectations are.
Thank you. Secretary Romero, who would I reach out to as far as your economist?
So Dr. Leo Delgado.
Okay, I certainly will. And I did want to point out, as we did with the recent hearing that we had, we are finding as we hire people, and certainly Vince is challenged, I've been challenged. We, I think for the recent accounting hire, it took us probably 18 months to fill that position. We had to actually bring that individual in at a little bit higher level as far as salary to actually get them in the door. And that poses problems with the existing staff. So we're probably going to have to make some adjustments up in that regard, and hopefully that'll be coming in the future as well. But I certainly appreciate your comments.
So we're seeing that across all state agencies, not just the investment agencies, it's across the board. And so we understand that agencies are having to pay more to bring employees in, and then they're having to make adjustments to bring the other employees up to, so that we don't have morale issues and we don't have the other issues come up. So that's the landscape that we're in right now.
Yeah, I agree with stuff.
Mr. Chair, one comment. I wanted to back up what Brent showed, the 263 million. And I've told the story before, so if you've heard it, I apologize. But several years ago when the Bakken fields were coming up and North Dakota set up their future fund, A good friend of mine, Darren Schultz, was the CIO up there. And so one day Darren calls me and he says, Vince, I got a problem. I said, what is it? He goes, I got 100 million a month coming in the door. I don't know what to do with that. I'm looking for ideas. That's 263 a month. That's the magnitude of what we're seeing. So one of the best gas fields in the country was producing 100 million a month. We just threw 263 at our land office.
Unbelievable. It's just, those numbers are mind boggling.
Yeah, and I would point out, and I think I mentioned this last time, for the early childhood fund, we actually got a transfer that was, it's going to be basically set up as a receivable as of June of $1.5 billion. Okay. I've got large transfers, but when you get a transfer of $1.5 million and you're, or $1 billion, and you're having to deal with the custodian bank and they're calling you to make sure that you get it properly delivered and properly invested. I mean, in my wildest dream, I would have never expected anything that big. I'd also point out, I did have some discussions with Mark Melhoff. We're providing him some information on the tax stabilization reserve fund as well as the tobacco fund. We are expecting, as part of his year-end adjustments and additional inflows, an additional $1.3 billion to come in as of the end of June. So as far as like reserve funds and excesses that we haven't had in the past, we will definitely have them as of the end of June of 2022. And that's all I have.
And so I saw Dawn pop up, and so she's been part of that, Craig, in the past. And so I know that she will be able to provide you with a lot of information and help you through that process as well.
Thank you.
You bet.
Thank you, Secretary Romero. I just wanted to mention to you and to the council that I have been in contact with Leo as well as the rest of the consensus group, and the SIO presentation that Steve gave, sort of giving an outlook for future oil and gas inflows into the land grant permanent fund. We do that outlook does use the consensus revenue estimate, as well as information from Rystad Energy, which Leah has been gracious enough to provide us with. So I wanted to confirm with you that we are in close contact with them, and the inflow expectations that you will see next month does use those sources that you've pointed out.
Thank you.
Thank you. Brent, thank you. Thank you for the, continued good work that you and your staff do. I think that, we keep getting these no exceptions, no findings, reports, and that's really, I really do appreciate that.
And I would add to that. I've worked with some great professionals. I have within this organization on the accounting side and certainly on the investment side too, some great individuals to work with. And it makes coming to work and doing what you do a whole lot easier when you have great people to work with.
I appreciate that. You know what? I am going to have to say that your invitation to come to the audit exit, that for me, that kind of ranks up there with going to the dentist. So I really appreciate the invitation, but I'm afraid you're not going to see me at that one. I have a couple more little things to do here, but I just wanted to go on the record of saying that we talked earlier about the staff and about pay and about compensation and about our difficulties. And I'm not going to blow any smoke here, but I want to make sure that it's very clear that Steve and Vince have done an incredible job of amassing an incredible group of people here in this organization. And despite the limitations we have against the rest of the world relative to compensation. It's not just compensation. I know that living in Santa Fe, living in this area can be a great draw, but at the same time, the financial disparity is pretty incredible. And we've got an incredible staff here, and my hat's off to Vince and to Steve and to others for the fact that we've been able to amass this staff that we have. So anyway, I think it's important that we say that and that the staff knows how much they're appreciated, because the fact that we're down 2% when others are down 7, 8, 9, 10, 13, or we're down 7 and they're down 13 is pretty incredible when you get right down to it. I know Marcia and Matthias see it across the spectrum. You guys see the spectrum of winners and losers, and this is pretty amazing. Okay, enough there. Any other new, old, or new business at this point for either on the screen or in the room. The next SIC meeting is November 22nd. Obviously everyone will be apprised of the form. I'm guessing it'll probably be continue to be like this, but we'll know for sure. I sure hope we get to go back to being in person again, but completely in person, but who knows? Public comment. Yes.
Chairman, I'm sorry to interrupt. It's Mike.
Okay, Mike. Go ahead.
Just wanted to let you all know that I'm going to be out of the country on that date and be unable to attend. Sorry about that.
Okay, Mike. Thank you. Anything further from anyone? Charlie, anybody on the screen, or have you received any public comment requests?
We may have somebody in person,
right, but nothing on.
Not seen any other public comment.
Mr. Chair, it's been a long time since this meeting to introduce himself.
Yeah.
It's been about 2 years. And a lot has changed in my world. I lost a lot of friends and 4 partners in my business to COVID, and so Invest New Mexico has kind of taken a different approach to doing things. We're not working with small businesses as much as we'd like to because there's no capital right now. But one of the things we have done is we've been invested in buying land. We purchased 1,274 half-acre lots in Rio Rancho, and that means we're paying over $300,000 in back taxes and get current, and we're selling those lots and looking at lots to develop, which as the first month of operation, we did $200,000 in sales in land lots, which means they double the tax base with you pay for those lots. So it's all a unique thing to come and watch people allocate or spend over $500 million. And you guys are playing like billionaires. This is what billionaires do. I spent a lot of time in the Bay Area. I was on the board of directors of the and because of COVID, we're able to shelter yourself and actually do it without public access to technology. It's not as great as it seems, but you're good. You're doing great things. There's a different world I live in. In that I see a lot of very struggling businesses. I think when this first happened, I predicted, I put that online that the job losses and what would happen. So to see as much money invested, it's like 2 different worlds. My wife also is the money manager advisor for the Salmon Group, but she works with millionaires. And then here's you guys are working with billionaires. It's very, I don't know if you understand that. It's a different, seems like a different world. But it's what you're called to do. So, and you're doing a great job. I've said it, the State Investment Council and the fund to me is mind-boggling because it's like a monopoly game. What point is the game over and you spend the money? How big does it grow? Game's never over. So the game's never over. So it's just this big monopoly game. As people ask me to describe the State Investment Council, I said, it's a monopoly game. If you ever play Monopoly and you accumulate all this wealth, you spend all this wealth, except there are no losers. That game never stops, which is very unique. A friend of mine works in Kelpers. He's every time I talk to him, he says, "How's that big bank in New Mexico doing?" It's doing. they're not doing as well. But I hope I'm still invited to the meetings.
You're always welcome. Thank you.
Thank you, Mr. Knoll, Ken Knoll with Invest New Mexico.
Yes.
That's right.
So NewMexico.biz because of our partners, there's some restructuring. So we're no longer NewMexico.us because I had to do some change.
Well, thank you for your comments. I appreciate that. Does anyone have anything further for us to discuss today or to cover? Does anyone have any comments? If not,
Carol, it's
yes,
Kathy.
ma'am.
Yeah,
Yes,
I just wanted to reiterate how important, first of all, my appreciation for the State Investment Council employees and for Steve's leadership. I really think we are so lucky to have such high caliber talent in New Mexico and the results that we're having with the investments. I do think, going back to what Harold was saying earlier, I'm going to have a chance to speak to the governor on Saturday. I think all of us need to talk to members of our legislature and to the governor and any senior officials in the state of A, how proud we are of the State Investment Council, B, the importance of paying them well and the competition that's out there, and just keep up that information with them, because I think that's the way, if we have some pressure and they know what we're thinking, that's going to help to try to help with the budget, but also help in hiring and retaining talent.
thank you, Kathy. Anything further? Hearing no further comments, we'll call the meeting adjourned. Thank you, everyone. See everybody on the screen. Look forward to seeing you in person one of these days.